there's a lot of opportunity for those who want to do their homework and look in the equity market.
I think there's opportunities in things that aren't so obvious to people because they are more economically sensitive.
The income side of the economy is what has me most concerned. It's not a reason to panic, but it's a reason to understand why consumers are going to be more prudent.
The outlook for retail for the rest of 2024 may not be so strong.
Subsurface activity down the cap spectrum, you have started to see more improvement. And I think that's a healthy thing for the market.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. Your trading day starts right now for our audience worldwide. This is Bloomberg Surveillance, and your scores are shaping up as follows. We're down on the S&P once again, down by 0.3%. On the Nasdaq 100, down by 0.4. On the Russell, the small caps down by 0.3. Coming into Wednesday, attempting to shake off an ugly start to September following the biggest one-day loss since the early August rout. The one name to watch this morning, once again, in the pre-market, it's Nvidia. Nvidia trading just a little bit softer, down by 0.8%. It just had its worst day since April, down by just short of 10% in yesterday's session. A loss of almost $280 billion in market cap, the biggest single-day loss of market cap ever in the history of this market. Bigger than the market caps of Chevron, Pepsi, McDonald's and Wells Fargo, and almost the size of a Netflix. AMH, things getting worse this morning.
Yeah, things are getting worse. And after we saw the stock tumble yesterday, it was dealt another blow from Bloomberg's reporting about the DOJ. First, they sent questionnaires to companies like NVIDIA, and now they are sending legally binding requests, a.k.a. subpoenas, which is another step, Jonathan, basically the government to launching a formal complaint. When you look at the market share of NVIDIA and how much it controls, Missoula says it's about 70 to 95% for the market for AI chips.
I think this spooked a lot of people in yesterday's session. What was the sell-off really about? We'll get into that in just a moment. Here's the take from Bank of America. The 5th of August shock reminded us that markets can remain fragile, certainly fragile yesterday, and the stronger Fed put and AI bubble potential only raise fragility risk. Coming up through today, this is your lineup. A little bit later on today, we'll get the job openings coming up a little bit later. Then the beige book after that in the afternoon. Then on Friday, everything in anticipation. I would say anxiety building around this jobs report. The August jobs report just a few days away. The median estimate in our survey still in and around 160. And a lot of guests coming on this program, Anne-Marie, in the last couple of days, the last week or so, signaling that anything around 100 could tee up that 50 basis point cut.
And then officially, it's bad news is bad news. And how does the market read that if it's a 50 basis point cut? Is this the fact that the market says, well, the Fed has just been behind the curve? Or does the Fed signal to the market that bad news is bad news, and we're doing this because we actually see economic conditions are really worsening?
Equity futures right now, just a little lighter, softer, negative by 0.25%. If you're just joining us, welcome to the program. Here are the scores in the bond market. Treasury yields on a 10-year at the moment look a little something like this, down 2 basis points to 380. On a 2-year, we're down about 3 basis points to 383. And foreign exchange, the euro, just a little bit stronger. Not much price action there. Euro dollar 110.53. Coming up this hour, we'll catch up with Russ Koesterich of BlackRock, following Nvidia's record-breaking one-day loss. Baker Hughes CEO Lorenzo Simonelli on his outlook for energy markets, and Kate McShane of Goldman Sachs on the health of the US consumer. We begin with our top story. Traders kicking off September with a bad sense of deja vu after stocks posted their biggest one-day decline since the August 5th sell-off. Russ Koesterich of BlackRock laying out two reasons for yesterday's weakness. A reversal of Friday's late-day melt-up, which occurred on a traditionally low-volume day, and B, investors positioning for what is generally viewed as likely to be a more volatile fall. Russ joins us now for more. Russ, how difficult was it to explain yesterday's price action?
Good morning, Jonathan. I think it was pretty difficult. You know, you could point to a couple of fundamental things, the most obvious being you had a soft ISM print, which, you know, we all remember, also contributed to the early August sell-off, but it wasn't that bad. And I think a lot of what happened was you had this melt up on Friday, you had a strong close to the month, people repositioning, and you have some positions that we know are somewhat crowded. So I would say that was more of a technical adjustment than any major shift in the fundamentals.
Do you think things are lining up for an August 2nd repeat, an August 5th repeat?
Well, we already had a bit of it on yesterday. I think what's happened goes back to the comment a moment ago. You know, we're back in a world after several years where bad news was good news, and now bad news is bad news. And when you looked at the ISM number, again, it was not terrible, but it was soft. we saw the new orders component move down further. And I think this played to the fears that really have been dominant since early August, which is, what if the economy is softening more than we think, more than the Fed thought? And what does that imply for the market, and particularly for 2025 earnings, which are somewhat aggressive?
Well, we heard from the chair of the ISM, Russ, yesterday, who said we're not going to see things really start to change here until December, January. People are waiting about interest rate reductions. There's also concerns, obviously, about the U.S. election. Could this potentially be a self-fulfilling prophecy when it comes to the manufacturing sector?
Well, I think the economy overall, I mean, as you know, Emery, you have these moments when confidence sentiment does drive actual economic behavior. But again, I think it goes to a few questions around uncertainty. What is the Fed going to do? I think the other big question is, what is the U.S. consumer going to do? Now, our view is they're actually in decent shape. The labor market is still relatively healthy. Balance sheets are much better than they were 10 or 20 years ago. So we're not expecting a collapse. But there is no doubt the consumer's slowing. We're seeing pockets of pain in some of the low-income groups, and that is having an effect on behavior. And that's another thing that people are watching very closely to see how this feedback loop starts to take effect.
What about the fact that we have uptick in prices paid? Are you concerned about potentially inflation reaccelerating?
Not particularly. I mean, there are definitely pockets where inflation has been slow to decelerate. We see that in the U.S. We saw that in owner's equivalent rent. We see it in Europe on the service side. But in general, our thesis is prices are heading lower. And if you think about some of the input costs, if anything, if you look at the tape over the last few days, last few weeks, we've seen commodity prices pull back fairly significantly, whether we're talking about iron ore on softer China data, whether we're talking about oil. So right now, I don't think the biggest issue is input prices. I think what people are going to be watching is demand.
So, Russ, let's talk about capital allocation. We have caught up a few times over the last several months or so. It felt like you were pulling back your allocation to equities just a touch and trimming, reducing the overweight in tech. Where else have you been pulling back?
We've generally been reducing risk, so we've been doing a couple of things. We have been pulling back our overweight in equities. Most of that has been on the technology side. We've also reduced our underweight to duration. We're still a little bit underweight on the long end of the curve, but relative to where we were 3, 6, 12 months ago, we're much closer to benchmark than we've been in some time. Obviously, that reflects the fact that we have seen this improvement in inflation and this dramatic shift in the Fed's reaction function.
Can we talk about foreign exchange and the link to risk too? Dollar yen at the moment around 145. Had a breakdown in yesterday's session. Just a reminder that the BOJ is still keen on hiking interest rates, Russ. Do you think we have reduced the link between what happens in foreign exchange and the relationship with risk assets, particularly here in the United States?
I think you did clear out a lot of that trade, but it's one of those things that it's not important until it is. And you already hear stories about, well, now the Swiss franc might be the funding trade for the carry trade. I think what it does go to is less about the dollar yen. Obviously, there's some very interesting dynamics there with the BOJ looking to normalize policy. At the same time, most central banks are looking to ease. But the bigger question is, where is there still crowding? We know that there was crowding in some of the AI themes. We know that there was crowding in some of these currency markets and carry trades. And this is always the risk, that when you start to see this pullback in risk appetite, where else do you start to see these little explosions that can disrupt markets?
When we see the pullback in things like technology and AI, Russ, do you think individuals should actually buy these moments?
Again, I think it depends on the name, but in general, our view is that these themes are going to work long term. So yes, if you have a 5 to 10 year horizon and you're seeing pullbacks that were 10, 15, 20%, I think at one point, early in the summer, the semiconductor index was down 25, 30%. That probably created an opportunity. So if you can have a long-term perspective and you're thinking about what are the themes that are going to generate earnings growth, cash flow growth over the next 5 to 10 years, I do think we're going to see some opportunities later this fall as you take advantage of some of the volatility.
Russ, let's discuss where else there is some crowding, particularly in foreign exchange. You mentioned the unwind of the carry trade. Kit Jukes of SocGen put it like this in the last 48 hours. The focus on the carry trade is to miss the bigger story, which is the exceptionalism of US assets and the US economy. How deep, how entrenched, how much have we accumulated in a very, very deep, big, large dollar overweight over the last several years that needs to be unwound beyond just developments in dollar yen?
I'm I'm not sure I would agree with that. The dollar obviously has had a very strong run for a long period of time, but that did reflect economic fundamentals. It did reflect what was, whether you call it U.S. exceptionalism or just a differential in growth. And obviously, it reflected a Fed that was engaged in the most aggressive tightening campaign in 40 years to bring inflation down. But if you look at the long-term outlook and you think about many of the companies that had been outperforming and why the S&P 500 was such a strong performer, a lot of that was based on the underlying fundamentals of not only the U.S. economy, but the U.S. corporate sector. And I don't think I would describe that as a bubble.
So, Russ, do you not think that period of U.S. exceptionalism has come to a close, though?
No, I don't think that U.S. exceptionalism, however you want to describe it, if we're going to define that as the ability of the U.S. economy to be resilient, if you're going to define that as the high quality of many of these world-beating companies, no, I don't think that's come to a close. Yes, many of those trades have become crowded. You may not want to chase it at these levels, but the underlying fundamentals, I think, are still solid.
Russ Koesterich of BlackRock. Russ, appreciate your time, sir. As always, thank you. Trying to make sense of what is difficult to make sense of in the last 24 hours or so. If you are just joining us again, welcome to the programme. Lots to talk about. The biggest one-day loss on the S&P 500 since the early August rout to kick off the month of September. Equity futures right now on the S&P still lower. We're down by 1/3%. Let's give an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Cathay Pacific is cancelling more flights from Thursday to Saturday. It's still inspecting its fleet of Airbus A350 jets and Rolls-Royce-made engines. At least 15 planes need to have engine fuel lines replaced. At least 90 flights have been canceled in total. Earlier this week, a part failure forced an A350 aircraft bound for Zurich to return to Hong Kong. And John, as you and Anne-Marie mentioned, NVIDIA facing a new subpoena from the DOJ, part of a growing antitrust probe. People familiar with the matter telling Bloomberg the legally binding request puts the government one step closer to launching a formal complaint. Antitrust officials are concerned that NVIDIA is making it harder for customers to switch to other suppliers, and at the same time penalizing buyers that don't exclusively use its AI chips. Before the announcement, NVIDIA shed $279 billion in yesterday's wider equity rout. That is the most ever for a single stock. And just sticking with NVIDIA for a moment, CEO Jensen Huang's wealth tumbled the most ever after yesterday's sell-off. His net worth slumped about $10 billion, now stands at $94.9 billion as of the close on Tuesday. That's the biggest single-day drop for him since the Bloomberg Billionaire Index started tracking his wealth in 2016. And that's your brief, John.
Hey, Danny, thank you. More from Danny in about 30 minutes' time. Breaking news in the last couple of seconds from the Wall Street Journal. Sitting down with the U.S. Steel chief executive, the company would close steel mills and likely move its headquarters out of Pittsburgh if its planned sale to Nippon Steel collapses. The CEO saying that the nearly $3 billion that the Japan-based Nippon Steel has pledged to invest in the Pittsburgh company's older mills is critical to keeping them competitive and maintaining workers' jobs. There's a fly in the ointment of this campaign season.
Absolutely. And if you're hearing this from the U.S. Steel CEO, do you need to change your policy position? He goes on to say, we should remind people, this is someone who's really tried to stay out of the political spotlight when it comes to this deal. We wouldn't do that if the deal falls through. I don't have the money. They need this cash injection in order to maintain those factories and, what he says, those people's jobs.
More on this story in just a moment. Up next on the program, tax policy on the table.
If Donald Trump were to be reelected, he intends to give more tax cuts to billionaires and big corporations. He wants to impose what, in effect, would be a national sales tax. I call it the Trump national sales tax on everyday products and basic necessities.
Some of that conversation up next, live from New York City this morning. Good morning. America getting back to work, selling stocks and buying bonds. Equity futures right now, negative 0.4%. The move continues. Yields a little bit lower once more, down by a basis point or two. The 10-year, 381.39. Under surveillance this morning, tax policy on the table.
If Donald Trump were to be reelected, he intends to give more tax cuts to billionaires and big corporations. He intends to cut Social Security and Medicare. He wants to impose what in effect would be a national sales tax, I call it the Trump national sales tax, on everyday products and basic necessities.
So here's the latest. Kamala Harris preparing to unveil a second wave of economic proposals at a speech in New Hampshire this afternoon. A campaign official saying the new policy would increase the small business tax deduction for startup costs from $5,000 to $50,000. With the election just over 2 months away, Rob Casey of Signum Global Advisors saying we still feel very confident in our Harris win base case with a divided government. Harris has pulled ahead in the majority of swing states. She benefits from two distinct trends: asymmetric turnout and asymmetric incumbency. Rob joins us for more. Rob, good morning to you.
Morning.
Translate the last line of that. Let's start there. Asymmetric turnout, asymmetric incumbency. What does that mean?
Asymmetric turnout, very simply, is that Democrats are going to be more motivated to turn out and vote in November than Republicans. Now, of course, the base of both parties will turn out on November 5th. But the question is, how does Kamala Harris, how does Donald Trump get the sort of fringe voter, the voter who maybe isn't super excited about either candidacy, to turn out and vote? We think abortion is going to drive turnout significantly, especially for women, Democratic women, in states like Arizona and Nevada, where abortion is explicitly on the ballot. And, you know, the economy is certainly an important factor, though Harris isn't getting tagged for it as much as Biden did. And the border, while voters are focused on it, we don't think polling shows that it's going to drive turnout in November.
Asymmetric incumbency. How sustainable is this?
Yeah, asymmetric incumbency, you know, I think for the most part it's sustainable. Harris gets to fly around on Air Force Two. She gets to stand behind the seal of the vice president, which to most of us looks a lot like the seal of the president. But polling shows that voters are not blaming her for inflation, for the state of the economy, to the extent that they're blaming Biden. So she gets all the pros without all the cons.
How has Trump not been able to identify her and tether her to Biden?
You know, it's really interesting to see the Trump campaign struggle to tag Harris with any sort of attack line. When Harris replaced Biden on the ticket, the reporting was the Trump campaign had been preparing for this eventuality for months. But it doesn't really seem as though they've had a great plan, and it doesn't seem as though Trump has sort of found the attack line that's going to work against Harris. Maybe he will during the September 10th debate, but otherwise we haven't seen it.
I know you're looking at the polls and you're seeing Harris edge slightly ahead of Trump in a lot of them when it comes to these swing states, but that's where we were in 2016 with Hillary Clinton. Why do you think this is different?
Yeah, you know, it's a fair point, and we get asked by clients a lot which direction polling is going to be wrong this time. Of course, in 2016, it underestimated Trump. In 2020, very much the same. It overestimated Joe Biden, although he wound up winning anyway. I would make a few points. The first is that I don't think there's a silent Trump voter anymore. That was the case in 2016. I think we're hearing from Trump voters, from those who are voting for Trump. They're proud. They're excited to vote for Trump. You know, former president, hopefully future president in their mind. But we don't know. Nobody knows where the polling error is going to be this year. At this point, you know, mid to late September, the polls are going to get as accurate as they will. We'll be within 3 to 5 points, hopefully. Of course, the error could be bigger. But directionally speaking, we don't know whether it's going to go left or right this time around.
You think this might come down to one state, Pennsylvania. I'd love your thoughts on this story that's just come out from the Wall Street Journal, speaking to U.S. Steel CEO, saying that the company would close steel mills and likely move its headquarters out of Pittsburgh if its planned sale to Nippon Steel collapses. That out just moments ago. Where are the campaigns on this issue now? And does this story change things?
You know, I think this story might change things. First of all, let me just say that we think that Harris's easiest path to victory is through the blue wall, Michigan, Wisconsin, and Pennsylvania. If she wins only 2 of those 3, she very likely has to win Georgia and either one of Arizona or Nevada. The polling shows that if she can just win Michigan, Pennsylvania, and Wisconsin, it's essentially over. The Nippon Steel story is an interesting one. I think Harris and Biden have sort of been caught out, and that is to say that they want to retain U.S. ownership. And the news today sort of throws a wrench in that plan and that policy proposal, you know, on the campaign trail. Now, I don't think Harris is going to pull a 180. At this point, it's too late, given what she said recently, Pennsylvania just on Monday. But maybe there is, you know, an opportunity for Harris to take a step back and say what's best for voters, i.e. what's best for workers in Pennsylvania, is a deal.
How much state intervention could we see? And forgive me for putting you on the spot. This story's only just come out, but where's this going in this country? If we're not going to allow foreign competition to come in and buy domestic champions, if that's going to be the direction of travel for the next year, the next 4 years, and maybe the next decade or so, what is the government's role in the marketplace going to be?
Yeah, you know, I think in a Trump 2.0 presidency, that would be the direction of travel, point blank, period. I think in a Harris presidency, there's a little bit of nuance, and that is, you know, hoping that we can continue to collaborate with allies, Japan included, and allow them to have access to the U.S. market just as they allow us access to the Japanese market, et cetera. So it's major intervention under Trump. I think it's minor intervention under Harris with an eye towards, strengthening NATO, strengthening essentially NATO of the South China Sea. So otherwise put, there's a little bit more of a balance between economic intervention and defense collaboration.
Japanese auto companies, though, are in the United States, and they employ thousands of Americans. Is this idiosyncratic because it is such a name brand of American nostalgia?
Yeah, I do think it's idiosyncratic. I mean, Japan's one of our greatest allies, so it doesn't really make sense that from a defense national security perspective, we would prevent them from participating in a key industry. But U.S. Steel is a major brand in this country. Of course, it's labeled U.S. Steel for a reason, and so I think that makes it very hard, especially on the campaign trail, for Harris, just like for Trump, to support a deal. I mean, frankly, this is a policy that is influenced more by, I think, the election and by the importance of Pennsylvania and Pennsylvania steelworkers in particular than it is about any sort of, straight ahead, conducive, helpful policy.
So can we talk a little bit about Pennsylvania to put it all together? Pennsylvania legislature, state legislature basically says Republicans are registering more. New registrations are coming from Republicans than Democrats. So what gives you the confidence that Harris could win that state?
Yeah, so here's what I'll say about Pennsylvania. It's interesting. This isn't the case for all states. If you register for a Pennsylvania driver's license, you're automatically registered to vote. So it's not necessarily that voters are, showing up to the DMV to register to vote proactively, right? It's you're getting a driver's license, you're renewing your driver's license, you're now registered to vote. So that's the first point. The second point I would make is, generally speaking, Democrats have a pretty significant lead in voter registration in Pennsylvania. So while Republicans are narrowing that gap, to a certain extent, and we wouldn't discount that, it's not as though Republicans are pulling well in the lead. And I'll just say, Anne-Marie, if voter registration was the thing that decided every election, none of us would be here talking about it. We would already know what will happen. It really goes back to that question of who will turn out in November.
Rob, wanted to squeeze this one out of you as well. This from Goldman Sachs in the last couple of days. We estimate that if Trump wins in a sweep or with a divided government, the hit to growth from tariffs and higher immigration, tighter immigration policy would outweigh the positive fiscal impulse. They say this about a potential Harris administration. New spending and expanded middle income tax credits would slightly more than offset lower investment due to higher corporate tax rates. It sounds like things are worse under Trump, according to Goldman, for growth, and less bad under Harris. Is it too early to make these kind of calls about the future and the impact on growth?
I think the election year trade is incredibly difficult. But I think as we look out 2 to 4 years, Harris is obviously not going to implement the tariffs that Trump would, although I do think Democrats will continue to keep spending on things like the child tax credit and, also furthering and continuing extending most of the Trump tax cuts for essentially anybody making $400,000 or less. It's about 80% of the country. Trump, on the other hand, I think he'll have a hard time bringing down spending to the extent that some Republican hawks, especially in the House, would like. And of course, Goldman, among others, incredibly concerned, I think rightfully so, about the impact, the potential impact of tariffs.
Rob, this was great. It's good to see you. Let's do this again. Rob Casey there of Signum Global Advisors. This story just dropped in moments ago. If you are just joining us, just to repeat it, coming from the Wall Street Journal, the US Steel CEO saying the company would close steel mills and likely move its headquarters if its planned sale to Nippon Steel collapses. This one just ramping up a touch in the last couple of days.
And the debate's going to be in Pennsylvania. So this has to be one of the key questions, especially as U.S. Steel now is going to rally employees today to say we need this deal potentially to keep our jobs.
Once again, becoming a big campaign issue. Coming up on this program, Lorenzo Simonelli, the Baker Hughes chairman and CEO on the Global Energy Outlook. That's just around the corner from New York. This is Bloomberg. Live from New York, welcome back to the program. Yesterday, the biggest one-day slide on the S&P 500 going back to August 5th. We all remember August 5th. That was a difficult morning for this market. Equity futures right now pulling back by 0.4, on the Nasdaq 100 down by 0.6. The small caps on the Russell down by about 1/3 of 1%. Switch up the board and turn the page and let's get to the bond market. The front end of the yield curve, the 2-year, 383.43. Yields are dropping by 2 or 3 basis points. Anxiety building ahead of the payrolls report on Friday. The estimates still coming in Our survey continues to build, but the median estimate for payrolls on Friday, still sticking at about 165. That's up from 114. Looking for unemployment to drop back to 4.2% from 4.3. I've repeated the call from Citi a few times. It's worth repeating once again. Andrew Honhor suggesting that if we come in at 4.3%, if we print around 125 on headline payrolls, this Fed goes 50. That's the call from Citi. Up to you whether you agree, but that's the call out there from Citigroup this morning. That's the bond market. Let's get to foreign exchange and wrap things up. I want to look at dollar yen. Dollar yen, was it at the epicenter of what we saw play out yesterday in equities? 145 on dollar yen, negative by a third of 1%, a stronger Japanese yen. Just when we thought we'd cut the link between what develops in foreign exchange and what happens in risk assets, just felt like it reinforced itself just a touch in yesterday's session. But I think it would be a stretch to point to any one thing as the reason why we had the move we had yesterday morning into the afternoon.
It was almost a perfect storm, and some are brushing off the ISM. Others are saying actually the ISM seems to be important in terms of the manufacturing sector in the United States. Then, of course, you had NVIDIA. There was actually 2 notes yesterday, Jonathan, talking about this idea that AI is not going to be like a light switch. It's not going to be quarters. It's going to be years in terms of where we could potentially see that growth. And then, of course, there's been a lot of commodities impacting the market as well. This concern around China and weakening demand there.
You mentioned NVIDIA, so let's get the update. Under surveillance this morning, one of our top stories in the last 12 hours or so. Bloomberg learning the US Justice Department sent subpoenas to NVIDIA as it seeks evidence that the chip maker violated antitrust laws. Officials are concerned that NVIDIA is making it harder to switch to other suppliers and penalizes buyers that don't exclusively use its AI chips. That stock is down by another 1% in the pre-market after dropping by almost 10 in yesterday's session. And this news coming after the close. So more pain for this name.
Right. This was the final blow, basically, for NVIDIA yesterday as we saw shares falling. I go to the stat from Mizuho Securities. What they estimate is pretty much sums up why the DOJ has some of these concerns. NVIDIA controls between 70% and 95% of the market for AI chips used for training and deploying models like OpenAI GPT. On top of that, the DOJ is concerned as well with some of its acquisitions recently, like Run AI, making it harder for these other companies to compete.
Stock is down by about 1%. I talked about that recipe, toxic brew, so to speak. Bramo's not here, so I'll use her phrase for her. The toxic brew, one part of that toxic brew, the data out of China, and this is the latest. Services activity expanding less than expected in August. The Caixin Services PMI falling to 51.6 versus 52.1 a month ago. The data adding to a picture of economy at risk of stalling and fueling this move lower that we've seen in commodities. Goldman, the latest to cut its outlook for copper, cutting it by 5,000 for next year, down from 15 to 10.
And when it comes to copper, actually yesterday, Bloomberg TV also caught up with Jeff Curry, formerly of Goldman Sachs, now at Carlyle. He had told us months ago this is the best trade he's ever seen in his career. Now he's saying there's a floor and there's a ceiling to copper because of all the noise coming out of China when it comes to things like tariffs in the EV space and also when it comes to the property market, which has been the huge drag on that economy.
Not just copper, not just iron ore, it's crude as well. Oil continued to fall after a meltdown of almost 5% in yesterday's session. Downbeat economic data from the US and China stirring demand concerns, while a Libyan official predicted a resolution to the crisis that has shuttered half the country's output. We have the smallest of bounces this morning on Brent crude by 0.1%, on WTI up by almost 0.2. Elsewhere, the Barclays Energy Investor Conference kicking off today in New York. Baker Hughes CEO Lorenzo Simonelli attending following a better than expected earnings report earlier this summer. The company seeing higher demand for its drilling services and equipment in international markets. I'm pleased to say that joining us around the table is Lorenzo. Good morning, sir.
Great to be with you.
Let's talk about the outlook. You raised the midpoint of that outlook. Competitors did not. A similar story with competitors, though, was this better international backdrop compared to, say, what's happening domestically. What explains that divide that's emerging right now?
I think, first of all, as you look at Baker Hughes, the strength of our portfolio is much broader than just oilfield services. And so as you look at the results that we posted in second quarter and also the increase in guidance, it's really based on that total portfolio capability that we have that extends into rotating equipment, compression, and industrial sectors as well. As you look at the international markets, again, they are going to continue to grow. And again, we said at the beginning of the year, we would see high single-digit growth in the international markets. We retain that view as we go into the second half. And as we go into 2025, the growth will still be there. It will decelerate. And it's really driven by the demand that you're seeing internationally when you look at the exports, for example, from Saudi Arabia, a lot of that goes to other countries. Very little comes into North America or goes into the developed marketplace. It really is a developing market aspect and the growing population. And demand for energy globally is increasing.
Can you talk to us about the headwinds domestically and where they're coming from? Is it off the back of the consolidation we've seen? We see more careful spending. Is it off the back of lower prices? What's driving it?
There's definitely a lot of the aspects of consolidation that have taken place. There's efficiency also that you're seeing within the production, which has enabled production to stay relatively flat and increasing in some cases. And so domestically, I think, again, we continue to see weakness as we look at the second half of 2024. And then also in 2025, really looking at North America to be flattish. The gas market may be increasing somewhat. But North America is really the operators being very pragmatic with their balance sheet. And again, capital discipline is the name of the game.
Yeah, you need a lot less capital now to produce even more oil than you had in the past. But you think it's going to be flat. Some of the numbers we've run actually see 13.9 million barrels a day coming from North America and then 14 in 2025. Do you think that's an accurate trajectory?
Again, if you look at between 13.9 and 14, you're looking at a very slight difference. And again, it's driven by the efficiency. It's very transactional in North America. So I think it's early to call right now, and we'll continue to monitor it. Baker Hughes is much more focused on the production side and also the chemical side. And I think what we are seeing is really a focus on existing wells and also improving recovery rates from existing wells. And that's where the mature asset solutions that we provide actually have a huge opportunity. And it's actually important to remember, 70% of the world's production comes from mature wells. And that's a well that's been in operation for over 25 years or has 50% of its reserve depleted. If you're able to increase the reserve recovery by 1%, you're going to add 2 to 3 years of the production required globally. So there's a big focus on capital discipline and maximizing the recovery rates from the mature assets that are available.
You also mentioned gas. Can we talk about liquefied natural gas? Because yesterday we actually saw the Energy Department go ahead with an export license because the Biden moratorium on these export licenses, the courts have pushed back. Is that a sign that potentially we could see more LNG come online?
First of all, very pleased that the license was given, and congratulations to the team there. I think as you look at the global expectations, it's that the moratorium actually ceases in 2025. As you look at the LNG demand, it's expected to increase. We've predicted that by 2030, we need an installed base capacity of 800 million tons per annum, and the US can contribute to that. That being said, you're never sure until it's done, and international projects are continuing to go forward as well. So the LNG will be available, and hopefully the United States also participates, as it's got plenty of gas that it can export.
A big focus on this programme over the last, I would say, 6 months or so has been the burden that's going to emerge on the energy grid in this country in the next several years. Every single day we talk about NVIDIA and CapEx spend coming from some major tech players, spending money, throwing money at data centres. Can you walk us through just the scale of demand you're expecting to see and what you're hearing from some of these utility providers and some of these companies, these tech firms, and the need for off-grid solutions that you can provide? How big is that growth opportunity for you?
It is a significant growth opportunity. And I think you said earlier, this isn't just about today, it is a long-term trend. If you look at some of the statistics out there, generative AI, the consumption of electricity by data centers, it's expected to double by 2026. That's going from 2% to 4% of the electricity usage. Think about that. That's the same amount of electricity that Japan uses on an annual basis. So from an installed capacity perspective, it's a significant increase. What do we have as a challenge? Grid stability, and also, I live in Houston. Today, I have power outages on a continuous basis. And we need off-grid solutions, and that's where distributed power comes in. That's where opportunities for modular capabilities of gas turbines that are packaged, smaller, off-grid, and they provide the stability to the data centers for ongoing operations. Because the other important aspect is intermittency is important because a data center can't go down. So you need to have that consistency of power generation.
What does growth look like in this area currently, and what will growth look like in the years to come for you exclusively, specifically?
For us, if you look at the industrial gas turbines that we provide, significant opportunity. Just look at the ratio of the increase on the electricity utilization from 2 to 4%. So we're looking and working with the hyperscalers, looking at the ecosystem, and we're looking at the opportunity of mini gas turbines being sold into this marketplace.
What's the overall contribution to your revenue mix do you expect to come from that in the next, say, several years? The reason I ask that question is we've seen a big rally in utility companies in line with the rally we've seen in AI firms. And if we're to sit here today and think about the changing characteristics of your stock, I'd need to know what the contribution from that area would be to the overall top and bottom line. What's that going to look like in years to come?
Yeah, as we look at it, and again, this could be from 500 megawatts to 1.5 gigawatts, and that's what we're looking at from a scaling perspective. And again, from a dollar perspective, it's going to range based on 500 million to potentially larger, and it's going to come over a series of years as we go forward. We look at it as a major new area that we can focus on. We've participated before, and we've played in distributed power generation, and we look at this as a growth vector for Baker Hughes.
A big concern to the U.S. energy industry has always been these cyber attacks, whether that's Colonial, what's recently happened with Halliburton. Have you seen any impact?
So we haven't seen any impact. Again, though, we're very vigilant. Obviously, cybersecurity is a big concern for everybody, and we're all taking the measures accordingly to put the controls in place and very much vigilant on a daily basis.
What does that look like, meaning being vigilant? Is that having the proper systems in place? Is there a lot of communication with the U.S. government?
There's definitely communication that takes place across the sector, and there's also trade associations that discuss it. From a standpoint of vigilance, it means making sure that we're doing our own testing on our own systems, making sure that we're putting in the controls, we're patching with the new security that's available, and also doing our own phishing exercises. And so we've got a team that continuously red team, blue team, and we test our own systems. But I also say you can never be too careful, and you've got to stay vigilant, and you've got to be prepared.
You've got a really busy day ahead of you. Before we let you go, this conversation's got a time horizon of multiple decades. The time horizon of this market at the moment is about 5 minutes. Can we just reflect on yesterday's price action? What's going on in crude, in energy markets at the moment? Is there a real tangible concern from your side around demand in China? What's it all about?
I think you're always going to have volatility on a daily basis, and it's something we deal with in the business world. At the same time, leading a company, you got to focus on the fundamentals and the fundamentals of the long-term trajectory and make the right investment decisions. That's what we're doing at Baker Hughes. And if you look at the macro tailwinds, I think it's undeniable that energy demand is continuing to increase. As you look at the population and you look at the development of nations, you also look at developed nations that are now seeing that they don't have enough energy as well, such as here in the United States. So we look at the macro aspect, and we're definitely seeing positive tailwinds.
Do you feel like the attitude to fossil fuels has shifted in the last 12 months? Do you think governments, particularly in the West, have had a bit of a reality check?
I think there is an understanding that it's not just about an energy transition, it's also about an energy expansion. And it's not about the fuel type, it's about reducing emissions. And that's where gas plays a key role because it is abundant, it's available, and you need affordable, secure, reliable energy.
Lorenzo, appreciate it. Got a long day ahead of you. Thanks for your time.
Thank you.
Thank you, sir. Lorenzo Simonelli there, the Baker Hughes CEO. Let's give an update on stories elsewhere with your Bloomberg Brief. Let's cross over to Danny Berger. Hey, Danny.
Hey, John. U.S. Steel says it will likely close mills and move its headquarters out of Pittsburgh if a planned sale to Japan's Nippon Steel collapses. The Wall Street Journal reporting that CEO David Burritt says the nearly $3 billion that Nippon had pledged to invest would be critical for remaining competitive and maintaining jobs. Lawmakers from both sides of the aisle, including both presidential candidates Donald Trump and Kamala Harris, oppose Nippon's takeover. A former top aide to New York governors Kathy Hochul and Andrew Cuomo have been arrested on federal charges of acting as a foreign agent for China in exchange for millions of dollars. The indictment names Linda Sun and her husband, Chris Hu, who's accused of money laundering. The U.S. alleges Sun acted on behalf of China, blocking Taiwanese representatives from state access. And the Philly 76ers are being courted by the state of New Jersey to relocate across the Delaware River to Camden. Governor Phil Murphy is pledging to offer government incentives and make land available near waterfront for a mixed-use complex. There have been discussions about moving the Sixers from their current home in South Philly to a new arena in Center City, but those talks have stalled. And that's your brief. John.
Hey, Danny, thank you. More from Danny in about 30 minutes' time. Up next on the program, retail caution.
I do think that as interest rates go down, which will likely be through, of course, the rest of this year, 2025, we may see some rebound. But the truth is that retailers don't have a lot of pricing power right now.
That conversation on the other side. We'll catch up with Lisa in just a moment. From New York City, this is Bloomberg. Sneak peek of the price action this morning, still down, softer by 0.4%, nothing like the losses of yesterday, but adding to them. In the bond market, the rally continues, yields lower by a single basis point, the 10-year 381.96. Under surveillance this morning, retail caution.
I do think that as interest rates go down, which will likely be through, of course, the rest of this year, 2025, we may see some rebound. But the truth is that retailers don't have a lot of pricing power right now. So they have to be much, much more cautious about how they are charging shoppers, and shoppers are shopping around. They are looking for everything from secondhand goods to bargains wherever they can find them.
So here's the latest. Goldman Sachs is hosting its annual global retailing conference with major businesses focusing on consumer trends. Kate McShane of Goldman Sachs saying the following: we have seen growing concerns around the health of the US consumer and more value-seeking spending behavior. However, our economists continue to see a resilient consumer and believe the concerns around weakness in consumer spending are likely overdone. I'm pleased to say that alongside Kate is Bloomberg's very own Lisa Abramowitz. Lisa, good morning.
Good morning, John. Good morning, AMH. Thank you so much for having me. And frankly, this is really the key question for so many on Wall Street and Main Street. Basically, how resilient is the consumer? And we talk about weakness. At what point are we talking about actual weakness versus just it's getting competitive out there? Kate McShane joining us here. Kate, thank you so much for being with us. I am curious, how much weakness is there? Do you give credence to this story that the consumer is fragile?
Yes. So good morning. Thanks for having us. I think when it comes to the consumer, what we continue to see is a somewhat steady consumer. I think what we've heard from most of the companies that we cover is that not much has changed with the consumer over the last 6 months. They're employed, wages are growing, but they are being choiceful. And part of the reason why they're being choiceful is because there has been a lot of inflation over the last couple of years. Their money doesn't go quite as far. So you are seeing choices between consumables and discretionary. You're seeing choices between services and goods. And I think that's what's differentiating maybe some of the different performances that you're seeing out of retail coming out of the second quarter.
So how do you square this idea that we keep hearing this, and yet margins are expanding?
Yes. Well, there is some growth, so there is some leverage in some of these retailers' models, but at the same time, you've seen costs dissipate, especially on the freight side of things. And so there has been some improvement in margins as costs have come down on freight.
Okay, so it's more of that story and not so much that AI is creating this incredible efficiency that's overwhelming any potential price losses and pricing power that they're losing.
Not yet. I mean, we are starting to hear more, of course, about AI, just like we are across all the other industries, but it's much more nascent and more about efficiencies with regards to getting more efficient with how they catalog online with their e-commerce and maybe freeing up some tasking for their labor. But there isn't anything of scale yet that we've seen that is revolutionizing, what's happening with margins in retail.
So just to be clear, when people say maybe some of the increased productivity that we're seeing that's leading to these higher margins stems from the idea of AI making inroads, not really seeing that quite yet.
I don't believe so. Again, it's being talked about, but I don't think it's being touted necessarily as one of the bigger drivers of why margins are better year over year.
When people talk about a more choiceful consumer or a more discretionary, how much are they talking about just a sort of stagnant pool and greater competition to get that pool? And I'm thinking about higher income individuals. And increasingly, the holy grail has been just to get a chunk of that.
Yes. Well, they are speaking about the higher income individuals, too, with the choiceful consumer. And I think it's maybe less about consumables versus goods or consumables versus discretionary, but it's that services versus goods. Part of what we saw during the pandemic was a really heightened demand for goods, things, apparel, home goods, things like that, consumer electronics. And then as soon as the world opened up, you went back to services. We haven't quite seen that pivot back to discretionary goods. It was only on Target and Walmart's conference calls that they have just seen some stabilization in goods. So it's that choicefulness that's happening at the higher end as well, because they're choosing between services and goods.
So you've been doing this a very long time. You've been at Goldman Sachs 6 years. Before that, you were at Citigroup and Credit Suisse. And this has been a conference that's been going on for 31 years. How is this time different in terms of just the tenor of certainty or lack thereof, in terms of the economic cycle, as well as the interest rate cycle, as well as some of the technological overlays that you're seeing?
Yes. So the cyclicality is always the name of the game, right? Year to year, we're going to be in different cycles. And so certainly right now we're discussing about, the health of the consumer because of the interest rate environment we're in, because of what's happened over the last 5 years. But I think what's so different about the conference this year and what companies are going to be talking about is we are entering year 5 post-COVID. And most of the companies here had benefited in a significant way during COVID when everyone was shut in and needed to be entertained or needed to buy food. And now we should be entering a period in 2025 where it's more normal for consumer behavior. And so we're going to be focused on asking, in addition to the macro and what the expectation is for the health of the consumer, what their behavior looks like in 2025.
What are you seeing? What's the answer to that?
So we're still seeing that choiceful consumer, but as I mentioned with Walmart and Target, they are starting to see some stabilization in discretionary goods. And so our thought is that you will see more normalization of the consumer, balancing the choices between goods and consumables and services.
How much do you see the most powerful companies consolidating their market share in a way that we haven't really seen in the past? And I'm thinking of Walmart, I'm thinking of Amazon, I'm thinking of some of the behemoths.
Yes. We do think that that is an element that's happening across retail, too, the haves and almost the have-nots. And part of the phenomenon is that the scale and the one-stop shopping is really appealing to the consumer. So if we take Walmart as an example, it's not just the value that they're offering the consumer, the discounted prices, the rollbacks, but it's the convenience. It's the fulfillment optionality that you can get with delivery or click and collect or buy online and pick up in store.
What do you think is the biggest anxiety at this conference for the 80-some companies and executives that are here?
I do think it's figuring out the consumer. That's probably one. I would say tariffs is another. It's a big question mark as to what that looks like post the election, and it could be, very costly. And retailers are going to have to figure out what they do with their pricing as a result of that.
Kate McShane, thank you so much for being with us.
Thank you
for having us here. That was Kate McShane, U.S. retailing analyst at Goldman Sachs, here at the Goldman Sachs Retailing Conference. We'll be speaking to a host of CEOs coming up in the next few hours. John, back to you.
Hey, Lisa, thank you. Looking forward to it. Fantastic coverage still ahead on the programme. On the ground with Lisa Abramowitz. The lineup is as follows. Lisa will be speaking to on-holding co-CEOs Martin Hoffmann and Marc Maurer, and Manish Joneja, Walmart Senior Vice President for Marketplace and Walmart Fulfillment Services. All of that still to come. Coming up next on this programme, in the second hour of Bloomberg Surveillance, Drew Matus of MetLife, Bloomberg's Mandeep Singh, Ron Dermer is ready, Minister of Strategic Affairs, and Roger Hallam of Vanguard. All of that still to come. That is just around the corner. Futures right now pulling back by about 0.4% on the S&P 500, adding to yesterday's losses from New York. This is Bloomberg.
What's the overall slope of the data? We already know what that is. It's weaker.
The balance of risk is certainly on the downside of the labor market. That's a pretty significant change.
I really think the strength of the underlying economy has been largely underappreciated by a lot of market participants.
There are lots of warning signs right here and lots of reasons to be cautious, and most people aren't right now, and that's my big fear.
This is really one of the most interesting times, Lisa, I've seen for the Fed. We are just in a different economy.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
We said it earlier this morning, a bad sense of deja vu in this market. The start of September feels a lot like the start of August. Equity futures down again after the biggest one-day loss since August 5th on the S&P 500. Here are your scores. Equity futures down by 0.4 on the Nasdaq 100, down by 0.8 on the Russell. The small caps off by 0.5%. The anxiety building going into payrolls Friday. Your week ahead and your day ahead shaping up as follows. JOLTS job openings out a little bit later on today. We'll get the Fed's beige book as well. And then it's on to tomorrow when we get numbers for jobless claims, the ADP report, and the ISM services print. And then the big one on Friday, the payrolls report, the median estimate in our survey in at around 160 over the last couple of days. And expectations still for unemployment to pull back from 4.3% to 4.2%. In this market, where do you begin? Where do you end? Let's start right here and take a look at crude. Crude getting hammered in the last 24 hours, recovering right now by 0.9% on Brent. WTI up by a little more than 1 full percentage point. AMH, a story on OPEC dropping just moments ago.
Yeah, they're now discussing a possible delay to this potential output hike, increasing supply, adding more supply that many thought they were going to go through with. And that's because potentially some will say that the price is dropping too much, but also Libyan oil barrels potentially be coming into the market. This is according to the central banker, Al-Sadiq Al-Habir. Basically what he is saying is that there is a political agreement potentially to see more barrels come to the market. If Libya adds more barrels, why does OPEC need to cut? Especially as you have this growth concern surrounding China.
It's a reality check for OPEC. Crude right now, 74.47 on Brent, in the low 70s on WTI. A brief break of 70, 71.15 on WTI crude. Speaking of reality checks, let's talk about reality checks for governments on either side of the Atlantic. A reality check for this administration and any future administration, whether that's led by Harris or Trump, from the US Steel chief executive in the Wall Street Journal just earlier in the last hour or so, saying the company would close steel mills and likely move its headquarters out of Pittsburgh if its planned sale to Nippon Steel collapses. And it's not just coming on this side of the Atlantic. The reality check also coming in Germany as well. VW making some news over the weekend about potential factory closures in Germany for the first time in its 87-year history, and giving us some detail on the amount of overcapacity they have right now. 500,000 cars, the equivalent of around 2 plants. That's how much sales they've lost. They need to increase productivity and reduce costs. They have 2 plants too many. That is not music to the ears of politicians on either side of the Atlantic in the last couple of hours.
Absolutely not. When it comes to Germany, a big issue, especially with VW, is that almost half of their workforce is in Germany. So if you're thinking about closing factories, that means that these politicians are going to have to deal with potentially a huge labor issue. With Germany, the issues have been really on display for a while, Jonathan. Outsourcing their energy to Russia, they can no longer do that. And also just trying to gain that market share in China. Well, now China has big competitors, which is why the EU is starting to put up the tariffs. When it comes to U.S. Steel, what the CEO is now saying, an individual has been trying to distance himself publicly from this because of how political it is. He is saying we are going to have to close plants. We are going to potentially lose jobs here in Pennsylvania, this important swing state, if we don't get this cash infusion. I was reading the Heritage Foundation research last night. Heritage Foundation, which many point to individuals close to the Trump administration, they were talking about the fact that a U.S. Steel infused with new capital equipment expertise would be a daunting competitor, saying they need to survive, they need this infusion from Japan.
If you want to protect national champions from foreign competition, Europe, by putting up the walls. If you want to protect national champions from foreign acquisition, here, ultimately not allowing the sale to Nippon Steel to go through, the burden on the state becomes even larger. The burden on the state to provide the kind of state aid that would be required to keep these companies functioning. Isn't that the direction of travel here, ultimately? I'm really interested now to see how the campaign is going to change. It felt like things were set, that it was becoming a non-issue. Harris ultimately said Nippon Steel can't do the deal. Trump has already said Nippon Steel can't do the deal. Biden's basically said Nippon Steel can't do the deal. When US Steel comes out and says this, how does that language change in the coming days?
Well, Rob Casey's, who was on earlier from Signum, is basically saying they may have to recalibrate a little bit. This is why I think the debate now is even more important about policy. It is taking place in Pennsylvania. This has to be one of the first questions. Do you change your mind potentially about the fact that you've all been on the record saying this needs to remain in American hands? If the company is coming out, the CEO is coming out that's going to be rallying workers today in Pittsburgh, coming out and saying we cannot function without this deal going through.
That debate a week away. If you're just joining us, welcome to the program. Let's start with the scores again. Equity futures on the S&P negative by 0.5% on the S&P 500. Bonds still bid. The rally continues. Yields lower by a basis point or two. The 10-year 381.20. The lineup for the next hour looks like this. Coming up, we'll catch up with Drew Matus of MetLife on the global stock sell-off, Mandeep Singh of Bloomberg Intelligence as Nvidia faces an escalating antitrust probe, and Roger Hallam of Vanguard ahead of a critical week of US jobs data. We begin with our top story. Stocks coming off the back of the biggest one-day drop since the August 5th rout, as anxiety grows about the state of the US economy going into a slew of jobs data this week. Starting with jobs this morning and ending with the payrolls report on Friday. Drew Matus of MetLife joins us now for more. Drew, welcome to the program. Let's start with the credibility of the US economic data. Of the data this week, would you put more weight on some versus others?
Sure. I'd probably put the beige book above JOLTS because we know that one is just kind of what people are feeling. Whereas JOLTS, because of the low response rates, the potential for revisions, it used to be a data series that only economists paid attention to, and there was a good reason for it. And now that it's kind of gone mainstream, it wasn't quite ready for prime time. You're having this problem across a slew of data, including in the payroll report we'll get on Friday. So we have to be really cautious here about overreacting to kind of individual events. I saw kind of the compilation of people talking about the economy before the show started. And Neil Dutta had it right. It's a matter of kind of the direction of travel. The direction of travel is towards a weaker economy. We shouldn't be surprised by this. This is what the Fed wanted to achieve when they took rates higher. The only question we have to ask ourselves now is, how much pain are they willing to tolerate in terms of the unemployment rate moving higher before they actually act? And when they do act, how fast do they act?
Before we talk about monetary policy, Drew, can we just work through payrolls on Friday? How will you navigate that report? Are you ultimately suggesting you'll put more weight on, say, the household survey versus the establishment survey? How will you navigate that report, those reports, on Friday?
Certainly, I'm not going to be actually looking at the payroll numbers. I'm going to be looking at unemployment. It doesn't matter if it's a supply phenomenon or a demand phenomenon. If the unemployment rate's moving higher, people's ability to kind of get higher wages for their work goes down, right? There's more people per job. There's not enough jobs to fill kind of the people who want them. And so you're going to put downward pressure on wages there. So you can just look at unemployment. You can keep it simple. You don't have to kind of go into the detail. You can also see how many hours they're working. And how many hours they're working is actually quite important. Even though the economy's been quite strong and there's been a good amount of payroll growth according to the data, if you look at the number of hours they're all being asked to work, what we see is actually weekly wages haven't been keeping up with inflation. And so a lot of Americans who feel like they're falling behind are in fact falling behind. And they're falling behind because even though their average hourly wages are going higher, the number of hours they're being allowed to work is going down. And so in my mind, you want to watch the hours worked, because if that keeps moving lower as it has been, eventually that'll lead to job cuts, because people realize that they can't spread the number of hours of work they have among the existing stock of employees that they have, and they have to reduce the number of employees they have.
Drew, how hard is it to read the jobs reports now, given the fact that a few weeks ago we knew about not just normal revisions, but really massive revisions when it comes to the U.S. job market?
Well, that's why it's important to look at everything holistically, right? You don't want to just look at payrolls. You want to look at what's going on with claims. You want to look at the ISM employment numbers. You want a sense for kind of where the entire economy is going. And you don't really want to fixate or put too much weight on any individual component because of the potential for revisions or data quality issues. Which quite frankly, working as a U.S. economist for a long time, data quality was never an issue before. And post-COVID, data quality is increasingly an issue, and we have to be aware of it and make sure that, we're adapting to kind of a new data quality environment where revisions are larger. That creates the potential for more volatility in markets. And we have to not just look at one thing, we have to look at the totality of the data.
If the data quality is not as good as it used to be, do you need to start looking more at what executives are saying, what's in earnings reports? Is that more important?
I mean, earnings reports are a great way to get a sense of things. They're not exactly perfect, because what you find is that sometimes people blame things on the economy, and in reality, it's not the economy, it's them. But I do think, you do want to look at those kinds of reports. You want to look at things like the Beige Book, right? They've been doing the Beige Book for a long time. They know the people they're talking to, the conversations they have with their contacts, can lead to some great insights in terms of the direction the economy is heading. But I don't think anyone's confused about the direction the economy is heading. It's clearly slowing down. No one's saying that the economy is accelerating from here. The real question is kind of the speed of the deceleration. Are we slamming on the brakes, or are we just tapping them? And if it's tapping versus slamming on the brakes, how fast does the Fed have to move?
Drew, I'd love your thoughts on the next month or so, just the next few weeks. It feels like, from the people we've been speaking to, the bar to go 50 is actually pretty low. I mentioned the view from Citi earlier on this morning that ultimately they think 125 on payrolls, 4.3% on unemployment, which is where we are. They think that's sufficient to go 50. Drew, do you see it the same way? Because when I listen to Fed officials, I don't see them viewing it like that at all. I hear things like methodical, gradual, a reluctance to go big until they see something much more damaging.
I agree with you, Jonathan. I think if they were going to make a large move, they would have gone in July, at the very least, right? So they would have started a slower pace in July. I think perhaps maybe we can all hope that they've learned that if you miss the bus, you can't run after it and try to climb on it while it's moving, because that's what they do with rate hikes, and that's why we're currently seeing the slowing we're seeing and a lot of the dislocations in markets that we're seeing. So, if you miss your window, you can't catch up, right? This is not, the economy's not that simple. So, 225 basis point cuts over a period of time versus a 50 basis point cut in a single meeting are two very different events, and will have very different effects on where the market will price in, cuts over the next year, right? If you ratify market expectations of 50 now, that's going to price in, it's going to ratify market expectations across the next year or so. Whereas if you go to 25 and you say, look, we're calibrating here, then the market will have a very different response, and maybe one that will allow you to actually maybe eke out a few more cuts and get policy down to a point that's a little more, in line with the sustainable growth in the economy.
You and Neil are very much on the same page. Drew, thank you, sir. Drew Matus there of MetLife, looking ahead to the economic data this week, raising questions about the credibility of some of these reports, and ultimately making a forecast on what the Fed will or won't do come September 18th. Equity futures right now on the S&P negative by 0.4%. The pullback continues, just not as vicious as it was yesterday. Let's take the opportunity to get you an update on news elsewhere with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. Well, the pullback in oil is not continuing this morning. It is higher by about 1% for NYMEX crude. It sank 4.3% yesterday to its lowest level of the year. There's downbeat economic data from China and the U.S. that fueled demand fears. Meanwhile, on the supply side of things, a Libyan official said it was closer to a deal that would restore the country's crude flows. Following that drop yesterday, OPEC Plus is now discussing a possible delay to an oil output increase that had been planned for October. That, according to officials involved in the talks. BYD is putting plans to announce a major planned investment in Mexico on hold. According to people familiar with the matter, China's top EV maker won't make a decision until after the U.S. election. BYD was scouting 3 locations for car production facilities in Mexico, but has stopped actively looking for now. U.S. political uncertainty also led Tesla to delay plans for a factory in Mexico. And shares of Dollar Tree plunging nearly 12% in the pre-market trade. The discount retailer reported second quarter earnings that fell well short of estimates. The company also forecasted full-year net sales below prior forecasts. The company's CEO saying, quote, "We are encouraged by the continuous progress we are making, despite immense pressures from a challenging macro environment." That's your brief. John.
Some of the reports, the language coming out of the discount retailers, really not good over the last few weeks. Danny, thank you. Up next on this program, the Beltway versus Big Tech.
I just view this as more of a scarier headline than the reality. And also in the context of what's happening in Big Tech, NVIDIA is just part of the club that continues to be part of that pressure. Beltway versus Big Tech.
That conversation up next, live from New York this morning. Good morning.
It's Jobs Day, and Bloomberg has the report under surveillance.
It's from super hot to solid.
This is normal.
I think people underestimate the behavioral aspects when it comes to the labor market.
This Friday, Jonathan, Lisa, Anne-Marie, and Mike will bring you crucial data and expert analysis at terminal speed.
So what is bad on September 6th?
Nobody really has a full answer on it.
I don't know what counts as good news these days.
It's a big debate.
The August Jobs Report, Friday on Bloomberg.
Let's start with a snapshot of the price action, and then we can look at one single name. Cross asset, things are shaping up as follows. Futures, negative 0.5%. Bonds, still rallying. That risk aversion continues, down 2 basis points on a 10-year, 381. Let's talk about a single name together. Dollar Tree, cutting its outlook on muted consumer spending. Danny brought this stock up just moments ago. We're down by more than 12%. Think about what we heard from Dollar General in the last CEO. This was the CEO from the last week or so. This was the CEO a week ago. Inflation has continued to negatively impact these households, with more than 60% claiming they have had to sacrifice on purchasing basic necessities. A shocking headline coming out of that name in the last week on low-income shoppers. And you see it again this morning, Dollar Tree down by 12%.
The issue is a lot of these stores actually were the ones that were able to do well in times of economic stress for especially individuals in lower income scale. The issue is the competition right now that they're seeing from places like Aldi coming into the United States and Walmart.
It's a big struggle. That name is down by more than 12% in the pre-market. More still to come on that conversation. Under surveillance this morning, the Beltway versus Big Tech.
I just view this as more of a scarier headline than the reality. And also in the context of what's happening in Big Tech, NVIDIA is just part of the club that continues to be part of that pressure. Beltway versus Big Tech. We're not too concerned about this for NVIDIA. I think just because when you actually look at what's happened here from an execution, the reason that they've essentially dominated it is just because how stellar the execution has been and how they've just been so far ahead.
So here's the latest. NVIDIA suffering a record $279 billion rout, the biggest loss of value ever for a US stock on the back of renewed AI worries. This as the DOJ slams the chip maker with an antitrust-related subpoena over its marketplace domination. Joining us now to discuss is Bloomberg's Mandeep Singh. Mandeep, good morning.
Morning.
Simple question, maybe complex to answer, but what have they done wrong?
Well, so in this case, what DOJ is investigating is how have they distributed their chips to their customers. And anytime you have, a virtual monopoly, in this case, NVIDIA has over 80% market share in the GPU business. In an undersupplied market, how are they distributing the chips comes into question. And I think some of the focus is simply because their largest customers are the hyperscalers. So NVIDIA could potentially tell them to buy more. Otherwise, they can pull back, the allocation they have to a certain hyperscaler. So things like that, there's nothing clear, but NVIDIA is clearly trying to go up the stack. They have also made an acquisition that may come into focus as well. The deal hasn't closed. It's a small company called Run AI. But potentially, they may have to make some remedies. I still don't think there's anything big here.
Let's separate the purchase just for a moment. I just want to explore the supply. What are the alternatives? Where else would they go if they couldn't go to NVIDIA?
And that's the thing, right? So potentially customers could go to an AMD. AMD has a small GPU business, but in this case, there's a clear preference in the market for NVIDIA's chips, and those are more undersupplied than any other chips. So the question is, how is NVIDIA deciding who are the customers who should be getting the allocation? So if they, let's say, make 20 million chips in a year, how are those getting distributed? And I think that's where the question comes into play, whether SMCI, did they overbuy NVIDIA chips? Did NVIDIA ask them to overbuy those chips? So that, I think, again, nothing is clear, but because the market is so undersupplied, the question is natural, that how is NVIDIA working with its customers that's a concentrated base?
A lot of criticism has been NVIDIA's moat strategy. Can you actually explain what that entails?
Well, so, I mean, look, NVIDIA clearly has the IP when it comes to these GPUs. They also have a software layer, CUDA, which everyone talks about, how it makes their cluster better than some of their competitors. And now they're trying to move up the stack in terms of actually deploying the large language model. So they've been doing things way ahead of competition. That's why Intel is trailing and AMD has been lagging, is because they've been at least 12 to 24 months ahead in this market. And that shows up in the mode, that shows up in the scale, even though they guided conservatively for the next quarter, according to historical standards. But still, I mean, the ramp of the data center business has been nothing short of phenomenal.
So the DOJ is going after NVIDIA. Customers want NVIDIA chips. But Intel seems to be somewhat backed by the U.S. government. $20 billion grant. What's going on there?
Well, so that grant was more on the fab side. I mean, look, when it comes to chip design, I think Intel can make those chips and go to TSMC to have those manufactured, since they don't have the manufacturing capacity here. But what the U.S. government is giving them subsidies for is really to build the fabs here. And we know those will take time. That's where Intel still has to prove that their execution is working. But I think those are two separate things. NVIDIA is obviously a fabless vendor. It outsources all the production to TSMC, and everyone in the GPU space right now is going to TSMC to have their chips manufactured.
Before we saw, though, the DOJ news come out yesterday, the stock was already falling. What do you think was really the catalyst for that? What was driving this?
I mean, valuation. We talked about it during earnings. Like, you really need to see the estimates keep going higher. If the estimates are going sideways, that's not enough to sustain these kind of valuation multiples. NVIDIA was trading at over 35 times forward PE. At those kind of valuations, you better see your estimates keep going high. And the way they guided, it was a little conservative on the Blackwell side, the delays, and now there's antitrust. All these are incremental factors that will just prevent people from raising their estimates.
What does this volatility remind you of on this single name? Have you ever seen a stock move like this, a stock this size move like this, $270, $280 billion of market cap in a single day?
No, because the way NVIDIA has grown, its market cap has been nothing short of phenomenal. Like the way they came from 1 trillion to 3 trillion, there wasn't a lot of time in between. And that's why, you know, with these 1-2 day moves, they're sharp moves, but then in the grand scheme of things, it's still not that big. You know, yes, it's a $3 trillion market cap company. You would expect it to be more stable like a Microsoft or an Apple, and you don't want to see that, but it's not recurring revenue. And that's the biggest risk for NVIDIA, that this is not a recurring revenue business, although some would argue that you have to refresh your chips every year, you have to upgrade your data centers, so it will become a recurring revenue business over time.
Does that make you nervous?
Absolutely. I mean, that's the big risk, that even if NVIDIA executes phenomenally well from here, the valuation multiple may still compress, because what's priced in right now is that 50% plus growth going forward. I mean, everyone expects this year they will grow, they'll double their data center revenue. What about going forward? What is the free cash flow profile? The gross margin risk. Everyone talked about how the gross margin has peaked for NVIDIA, and for a good reason. They had some Blackwell delays. They need the distribution. And so if the gross margins are compressing, estimates aren't going up, the stock cannot keep expanding multiple.
You've flagged this for a while. Mandeep Singh of Bloomberg Intelligence. NVIDIA is down by almost 2%. Coming up next on this program, we'll catch up with Ron Dermer, the Israel Minister of Strategic Affairs. That conversation up next. quite an eventful start to the month of September, that's for sure. Equities down across the board. We're negative 0.4 on the S&P. We're down by 0.7 on the Nasdaq, down by 0.4 on the Russell. An eventful start that looked like this in yesterday's session on the S&P, the worst day since August 5th. On the Nasdaq 100, the worst day since July 24th. Late July and early August, a messy period for this market. Are we looking at a repeat of that going into payrolls on September 6th, this Friday? In the bond market, let's check things out. A 2-year, 10-year, 30-year shaping up as follows. Your 2-year at 383.43. If we can check out a 10-year at 381, we're down a couple of basis points there as well. Anywhere from 1 to 3 basis points lower across the curve from 2s out to 30s. This quote came from Ed Al-Husseini of Columbia Threadneedle in the last day or so. If you missed the big rally, it's going to be a little dangerous to chase it now. We are playing with the probability of the job market stabilizing here or deteriorating fast. That's the debate for the rest of the year, and certainly that's the debate right now going into payrolls. Switch up the board and turn the page. We want to talk about the commodity market and what's happening in crude. Crude bouncing after yesterday's losses on Brent and WTI. We're up by 0.6%. We were up by more than 1. News story out in the last couple of hours. AMH signaling that maybe OPEC is backing away from its supply decision later this year.
Right, they're maybe going to add some more barrels to the market later this year in the fall. Doesn't look like they might do that now. You saw prices yesterday really have a little bit of a scare. Part of that has to do with these concerns coming out of China, but also, especially OPEC wanting to potentially make this U-turn, has to do with the fact that we might see more barrels come from Libya. So if Libyan oil barrels get to the market, there's really no need for OPEC to bring barrels to the market, especially if they want to keep, Jonathan, a floor under this moral market, the price.
That's the latest on crude. Under surveillance this morning, let's get to some top stories for you. Kamala Harris set to propose a $50,000 tax benefit to boost new small businesses, increasing the current deduction tenfold. Harris setting the lofty goal of 25 million new small business applications in her first term if she's elected. It's another effort to try and signal that they're still going to be the party for corporate America at a time when we're not sure which party is what.
And it looks like they feel this administration, what we saw recently from Joe Biden, but also on the campaign trail from Kamala Harris, she's trying to feel like she can move towards the center. They have the progressives at the moment potentially lined up behind them. She wants to go out and say, we are for big business. But this all comes down to small businesses. But this all comes down to the tax fight for 2025. And you're going to hear a lot of people almost feel like they're throwing policy spaghetti at the wall and seeing what sticks. But this is all going to happen depending on the composition of Congress. Also, we should note, they come out with things, the Harris campaign, talking about price gouging. Then you have an economic policy advisor to Kamala Harris, Mike Pyle, come on this program, walk it back, saying this is just about regulation. We don't think it's grocers' fault. But then what do you see in the last 24 hours? Ads over swing states saying it is corporate greed, they're driving up your costs, and that is the responsibility for this greedflation.
Let's focus on one swing state. Let's focus on Pennsylvania and this story right here and how difficult it's going to be to navigate this in the months to come. The U.S. Steel CEO, David Burritt, telling the Wall Street Journal the company will likely close steel mills and move its headquarters out of Pittsburgh if a sale to Nippon Steel collapses. Both presidential nominees, and we know this from campaigning over the last 24 hours alone, Kamala Harris and Donald Trump coming out against the deal, the topic raising questions and tensions in the crucial swing state of, drum roll, Pennsylvania.
So with this new information, I want to know whether or not we're going to see a reversal, like we have seen from politicians, regarding this transaction. Donald Trump is going to be giving an economic speech here in New York tomorrow. Will he talk about this? Also, Jonathan, I know this is reporting in the Wall Street Journal, but the editorial board this morning scathing on both of these campaigns. They say a sign of the rotten political times that President Biden, Kamala Harris, Donald Trump, and J.D. Vance all agree on the dumbest economic idea of the presidential campaign so far, opposing this acquisition. They say because this is the money needed to make sure that you have a robust steel industry and a growing U.S. steel in Pennsylvania.
That's the latest on Pennsylvania. Let's get to the latest on the Middle East this morning. The Justice Department charging 6 senior Hamas leaders with terrorism and conspiracy to kill Americans days after 6 hostages were killed in Gaza. The charges including counts linked to the group's October 7th assault on Israel, as well as a string of other attacks going back more than a decade. The Attorney General Merrick Garland citing the death of a 23-year-old Israeli American in his statement. Joining us now to discuss the state of this war and the future is Ron Dermer, Israel's Minister of Strategic Affairs. Minister, welcome back to the programme, sir. I think we're all very, very focused on where we are in truce talks. And we'd like to start the conversation there, if we can. This came out from the Times of Israel, just reporting just moments ago that the Prime Minister Netanyahu sent the Mossad chief to Doha to inform the Qatari PM that Israel is still prepared to fully withdraw from the corridor between Egypt and Gaza in a deal's second phase. Can you confirm this morning for us, Minister, whether that reporting is accurate or not?
No, I think just to explain to your viewers what we're talking about, because there's been so much misreporting and half reporting. Understand that Israel currently occupies this corridor, which is between Egypt and Gaza. And that corridor, when it was left open and when Israeli forces were not there, was used as a supply route for all of the arms coming into Gaza. That's how they got armed. Their other borders actually are with Israel. And so the arms did not come from Israel. They came through that border. And Israel took over the Philadelphia corridor in the last 2 or 3 months. And also the Rafah crossing, and that has blocked all the arms and weapons from going into Hamas. The deal that is proposed on the table, phase one of that deal, Israel has made clear, and the Prime Minister made clear in a televised press conference a couple days ago, and I'm sure he'll speak to the foreign press soon as well, that Israel's not going to withdraw from that line. We won't withdraw off that corridor, because if we do that, then you're going to see those weapons come back. Phase one of this deal, what it calls for, Jonathan, is to have negotiations over the conditions over a permanent ceasefire. And once you've concluded those negotiations, while you're in a ceasefire for phase one, in order to get to phase two and a permanent ceasefire, that's when you can discuss long-term security arrangements on the Philadelphia corridor. So I think that report is a little bit misleading, thinking that in a few weeks Israel is going to leave. But it is true that Israel is committed to actually negotiating this deal. We've been committed from the beginning. When the president put forward a proposal based on a May 27th document, he put forward a proposal and a speech at the end of May. Israel said yes, Hamas said no. Then the U.S. put forward a final bridging proposal, which they called it a final bridging proposal, in the middle of August. We said yes, Hamas said no. Hamas has not been interested in moving ahead to close the deal. They were interested, frankly, Jonathan, for the last several weeks, in an escalation in the region. They wanted Hezbollah to attack Israel. They wanted Iran to attack Israel. And I think now they're hoping that somehow Israel's government will make compromise that it wasn't prepared to make it before. And I can assure you, Jonathan, in the wake of the horrific execution of 6 hostages, including an American, Hersh Goldberg, Poland, Israel is not going to make concessions in the wake of that. We are committed to a deal. We set people to sit with negotiators to try to get that deal done. And I hope we can do it. We're working with the U.S. administration to try to push that deal forward.
Minister, as you know, we're very focused on accuracy here at Bloomberg. So you said that report was slightly misleading. Can we just reconfirm the aspect of it that was misleading? And could you confirm whether in a second phase, Netanyahu has ultimately sent the Mossad chief to Doha to inform the Qatari PM that in a second phase you are willing to fully withdraw from that corridor?
We don't. I cannot talk about the arrangements in a second phase because we haven't even negotiated about it. Who is going to be there? How long is it going to take? I'll make it very simple for you, Jonathan. Until we have an actual practical solution on the ground for the Philadelphia corridor, Israel forces cannot leave. And for the last 20 years, we haven't had that. We had Egyptian presidents, and they announced that their policy was to stop the smuggling that would go into Gaza. We had that in Mubarak. We have that in Sisi today. What happened on the ground was a different matter. When Morsi was the president, you remember from the Muslim Brotherhood, was the president of Egypt, a highway of weapons came into Gaza. So the question is not necessarily Egyptian policy at the top levels. It's what's happening on the ground. What are you going to do on the ground to prevent that border from being a porous supply route for weapons to Hamas? Because we have
Minister,
to
it raises an obvious question, if I may jump in, sir, and just interject, because I'd love some clarity from you on this. Minister, I just want to squeeze this in and then you can complete your thoughts, sir, just quickly. If you can trust Egypt to mediate the talks, why can't you trust them to secure the border? Isn't that a contradiction that we need to try and reconcile?
No, I don't think so. By the way, Qatar is also a mediator of the talks, and Qatar has been harboring and financing Hamas for a long time, and frankly, financing the Muslim Brotherhood all over the world, and also promoting a lot of Hamas propaganda, which is anti-Semitic, anti-American, through their state-controlled television station, Al Jazeera. So I don't think those two are necessarily go hand in hand. The fact is, for the last 20 years, since Israel left in the disengagement, a move that was applauded by the whole world, we left that corridor called the Philadelphia corridor. We left the border between Egypt and Gaza. We have not had a solution on the ground. I'm not questioning the intentions of the Egyptians. I'm questioning the results. And all of Israel saw it. October 7th could not have happened without that border being open. And so Israel now has closed that. And until we have an actual practical solution on the ground that is working after 20 years of failure, Israel can't leave that line.
Minister, I need to follow up on one other aspect of this, and that's the division that might be emerging in the Israeli government. There was another report, and by all means, if this didn't happen, you can tell me it didn't happen, that your defense minister told the Security Cabinet the following, quote, "The fact that we prioritize this corridor at the cost of the lives of the hostages is a moral disgrace." So how do you respond to that voice coming from within your own government?
Yeah, I'm not going to get into private conversations. The Security Cabinet, I will just tell you that the Security Cabinet, of which I am a member, there are 10 of us in that cabinet. 8 of us voted to support the prime minister's position. 1 of us voted to abstain, and 1 voted to oppose. And he made a very clear position that Israel was not going to leave that corridor. And that is a position, by the way, Jonathan, that is, in my view, supported by the overwhelming majority of the Israeli people. I believe it is wrong to say it's either staying in the corridor or saving the hostages. It's not true. There are many other aspects to this deal that haven't been resolved. The United States is working diligently to try to resolve it with the other mediators and with us. Hopefully we can get there. But it is clear that in phase 1, Israel will stay on that line until we have a practical solution on the ground that we can convince the people of Israel will know that what happened on October 7th will not happen again, that Hamas will not be rearmed. They will not have an opportunity to do again and again October 7th, which is what they're saying. That's what they're saying today, Jonathan. That's what they intend to do. We've cut off the supply lines of weapons. We're not going to open that supply line without having a solution on the ground that works.
Minister, can we go back to this phase 1 agreement? A few weeks ago, Secretary Blinken was in Israel, and he said there was a very constructive meeting he had with Netanyahu and confirmed that Israel supports that bridging proposal. Then just this week, President Biden said Netanyahu was not doing enough. How do you manage what's coming out of the United States? What exactly does the U.S. want to see from Israel, and why is Israel not complying?
Well, I think that just the facts are, Anne-Marie, as I said, there was a proposal put forward in May. Israel said yes. Hamas wasn't interested in talks. They added so many changes, around 24 changes to that proposal. Then there was another bridging proposal in August, which was the one that Secretary of State Blinken was referring to. I was in his meeting with the prime minister, and it was a very constructive meeting. And Hamas said no to that. And the reason why Hamas said no at that time to any offer on the table is they wanted Hezbollah and Iran to attack us and to create a regional war. That's what they wanted to do on October 7th, and they wanted to do it in the last several weeks. My hope would be, hopefully, that the potential of a regional escalation is in our rearview mirror, and we can get down and see if we can finish these talks. What the last thing that Israel is going to do is, in the wake of the execution of 6 hostages, is to make concessions that it would not have made before. That is not going to happen. In fact, all the Israeli Security Cabinet was united that Hamas is going to pay a heavy price for that decision. Because if we don't do that, not only is it going to be dangerous for get to a hostage deal, they're going to start killing hostages, thinking that if you kill hostages, you get concessions. We're trying to get as much as we can on the same page of the Americans. I think we've been there for the last couple months. Hopefully we'll continue. And I think when the U.S. and Israel show no daylight between them, and when all the pressure is directed where it should be, on Hamas, I think the chances of getting to a deal go way, way up. And I hope we can get there in the next couple of weeks.
Is it your understanding that right now what the U.S. is putting on the table in these discussions, in these conversations, is, quote, take it or leave it?
Well, I don't know. The bridging proposal that was put forward on August 16th was a final bridging proposal. So I don't know if this will be a final bridging proposal, and then we'll get a final bridging proposal. It might be that they're talking about specifics and details, because this is a kind of framework agreement, and there's still a lot of things to be negotiated. Again, the problem in the negotiation is not just the Philadelphia corridor. There are several things, maybe a half dozen things that have to be closed in order to get to a deal. Right now, we have not seen, and I want to repeat this again, at no point has Hamas agreed to any deal that's on the table. They have rejected everything. We had one movement of Hamas, which was in early July, where they understood that there's not going to be an end of the war as an entry ticket into a deal. There will be a temporary ceasefire of 6 weeks. And then during that temporary ceasefire, we're going to have to negotiate what would be the conditions of a permanent ceasefire. The Philadelphia corridor and how you block weapons from going into Gaza is an important part of that. We're willing to negotiate all of that, and we're willing to get into that first stage of the deal. Hamas made that change. I don't know if they still actually agree to that. But on the other issues, there are still pretty significant gaps that have to be closed, and the U.S. is trying to do that. I will tell you that the Justice Department's decision yesterday was a very good decision to put pressure on Hamas. Hopefully, the other people internationally and regionally will put as much pressure on Hamas as possible because Israel's government wants to get to a deal. Believe me, Israel's government wants to get to a deal. What we're not willing to do is go to a deal that's going to endanger the security of 10 million Israelis. But we're willing to do a deal, and we hope we can get there as soon as possible.
Minister, you're saying you want to get to a deal, but just this morning, your National Security Minister, Ben-Gvir, came out on Twitter and said, quote, "I'm acting to halt negotiations with Hamas." So is that not accurate?
That's not the position of the government of Israel or the Prime Minister of Israel. As I've told you, we have different views of different government ministers, and the Prime Minister encourages people to say exactly what they think in all these meetings, but then you come to a vote. And the Prime Minister's position, which is we're willing to get to a deal, we want to get to a deal, we have red lines that we have to keep, but we want to get to that deal to bring those hostages back. Up until this point, we remember on October 7th, there were 250 hostages that were taken. We have succeeded in bringing 150 hostages back. 110 of them or so have been alive. And I tell you, the murder, the execution of these 6 hostages was gut-wrenching for all the people of Israel, no matter where they are on the political spectrum. You probably may have had them on the show, the Rachel and John Goldberg, Poland, what they have done in raising awareness about the plight of the hostages and their dignified struggle and heroic struggle really for their release. It was a major, major blow. And a lot of Israelis are angry, and I can understand that. I think that the anger has to be directed against Hamas in order for us to get to a deal. And yes, there will be people who will vote against the deal. I believe some of my colleagues in the government will vote against the deal. But the overwhelming majority of the country and also of the government backs the Prime Minister's position and wants to get to a deal.
Minister, you've been very generous with your time. Before we let you go, just a quick question. Will the Prime Minister be attending the UN General Assembly later this month in New York?
I believe he will, but, with what happens in our region in the Middle East, you never know. I think he intends to go there, and hopefully we can make that happen. And he'll have a chance, just as he addressed the American people in the Congress a couple of months ago, he'll have a chance to address the world about how we move forward in this region and how we can move from this catastrophe that happened on October 7th to move towards a different future for Israelis, for Palestinians, and for everyone in the region.
Please let the Prime Minister know we would love the opportunity to sit down with him later on this month, sir. Minister, thank you very much for your time. Ron Dermer there, the Israel Minister of Strategic Affairs. Let's give an update on stories elsewhere, just briefly, with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. Goldman Sachs economists are cautioning that the U.S. GDP will take a hit in a second Trump presidency. The researchers, led by Alec Phillips, wrote, quote, "The hit to growth from tariffs and tighter immigration policy would outweigh the positive fiscal impulse. Should VP Harris win with a Democratic sweep, Goldman said there would be a slight boost to GDP growth thanks to new spending and expanded middle-income tax credits, slightly offsetting the impact of higher corporate tax rates." Elon Musk's internet provider Starlink is reversing course, saying it will comply with Brazil's top court order to block the nation's access to X, formerly known as Twitter. The change follows a judicial order which froze Starlink's bank accounts. And the demand hit to aspirational luxury is forcing Swiss watchmakers to turn to the government for financial aid. Gerard Perregaux and Ulysse Nardin are the first brands to confirm that they're using the state assistance. So when Group CEO, which owns those manufacturers, called it a, quote, small watch crisis, under the government program, the Swiss state pays up to 80% of the workers' salaries. And that's your Bloomberg Brief. John.
Danny, thank you. Up next on the program, looking for a soft landing.
The fact that core inflation is running below 2%, to me, that suggests that they're already too tight. So going 50 on the first go is not a particularly big risk.
That conversation up next. You're watching Bloomberg TV. Stocks lower, bonds rallying, yields down by 2 basis points. The 10-year 381.39 under surveillance this morning, looking for a soft landing.
The fact that core inflation is running below 2%, frankly, if you look at it since last summer, we've been below 2% annualized on a monthly basis most of the time, believe it or not. To me, that suggests that they're already too tight. So going 50 on the first go is not a particularly big risk.
Here's the latest this morning. Treasury yields extending declines after yesterday's soft ISM manufacturing print. Traders bracing for more volatility with fresh data ahead, including jolts at 10 a.m. Eastern Time. Roger Hallam of Vanguard writing the following: we think the pricing of near-term rate cuts is a little too aggressive. However, we acknowledge that the bar for a more rapid pace of easing, should further labour market softening become evident, is low. Roger joins us now for more. So, Roger, with that quote, and welcome to the programme, sir, just how difficult is it to invest in this moment, given the risk to either side in either direction?
Yeah, I think when you look at the trend in data we received last week, the economy still has what I would say is pretty reasonable momentum. GDP growing at 3% in the second quarter. The July spending data still suggesting the consumer has significant momentum. But then policy is in restrictive territory, and when we look forward into next year, we do see the economy is likely to slow, potentially approaching what we'll term stall speed around the middle of the year. So, growth looks good now, but we do see slowing going forwards. I think the Federal Reserve acknowledges that as well. That's why they're set to start to ease at their September meeting. As I said in the quote, we think that the most likely scenario is the Fed starts to ease in a 25 per basis point clip, so 75 bips of easing this year. But we must acknowledge that with inflation now close to target and the labour market much looser than it was, those risks of a more proactive Fed easing stance, I think, is reasonable.
Roger, just how low is the bar to go 50? You mentioned the bar's low to ease even more. How low is it? What numbers are we talking about on Friday? And does it just come down to that one print?
I think it doesn't just come down to that one print, but I think, to answer the question, I think if we saw job gains below 100,000 or a further tick up in the unemployment rate, I think that the case for 50 would be reasonably high. Real policy rates north of 3%, and with inflation back at trend and a labour market that has come back into better balance, real policy rates of above 3% looks like the policy's in the wrong place. So the Fed is right to get started. And if the risks are increasing that we could see a more material slowdown in growth or the labour market, I think the Fed can easily get more aggressive this year. And I think that, as I say, the bar to that, I think it is very low.
When we begin to think about normal, what kind of numbers do you associate with normal, both for the incoming data in the payrolls report and for ultimately the destination for interest rates in this country?
Yeah, you look at the Fed's long-term neutral dot, we're in that 275 type region. We actually think the neutral rate is a bit higher than that, somewhere between 3 and 3.5. So that 200 basis points of easing we have over the next 8 meetings takes policy towards where we would think around that neutral level. Now, in a more adverse economic outcomes, that trough in the policy rate of 3%, we think can still fall materially further. Typically in more recessionary type episodes, the Fed takes the real Fed funds rate negative. So I think down to 3.5 would be neutral, but in more adverse economic outcomes, rates can still fall materially further than that.
Roger, your base case, 3 cuts this year, more cuts on the way next year. How do you consider cuts next year, even though we might have higher inflation, higher tariffs, very difficult to game out?
Yeah, I think the policy outlook for next year becomes a lot more uncertain. If you think that, say, real policy rates at 3%, I think it's going to be difficult for the Fed to avoid contemplating going 50 at some point over the next year if we do get some growth wobbles. And obviously we get the ups and downs in growth. It seems likely we will get a period over the next year where we do get a trend of weaker data. And the Fed at that point will have to make a serious decision as to whether the risk reward of actually picking up the pace of easing is favourable. And we saw that in prior easing cycles, that if in downside economic developments, the bar for the Fed picking up the pace of easing, delivering more than the market's priced in, that is a typical outcome for a Fed easing cycle.
Roger Hallam of Vanguard. Roger, appreciate your view. Thank you, sir. On the bond market, going into the jobs report this coming Friday, the estimate in our survey still in and around 160. If you want to see the price action, currently equity futures still pulling back by 0.4%, following the biggest one-day loss, going all the way back to August 5th, which was not a great time for this market. Coming up in the next hour on Bloomberg Surveillance, we'll catch up with Heinel of State Street, the co-CEOs of On Holding, Martin Hoffmann and Marc Maurer, and Amanda Lynam of BlackRock. More on that and a whole lot more from New York. This is Bloomberg.
a lot of opportunity for those who want to do their homework and look in the equity market.
I think there's opportunities in things that aren't so obvious to people because they are more economically sensitive.
The income side of the economy is what has me most concerned. It's not a reason to panic, but it's a reason to understand why consumers are going to be more prudent.
The outlook for retail for the rest of 2024 may not be so strong.
Subsurface activity down the cap spectrum, you have started to see more improvement. And I think that's a healthy thing for the market.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
90 minutes away from the opening bell, the third hour of Bloomberg Surveillance starts right now. Let's kick it off with the scores on the S&P 500, negative by 0.4%. On the Nasdaq, we're down by 0.7. On the Russell, the small caps off by 0.5. Adding to yesterday's losses, the S&P 500 with its biggest one-day drop since August 5th. On the Nasdaq 100, its biggest one-day drop since July 24th. The week ahead, been through this a few times. Here it is again. It concludes with payrolls Friday. The median estimate in our survey, around 160,000 jobs for the month of August. Later on today, we get the job openings data. That comes at 10 a.m. Eastern Time. Durable goods and the Fed's beige book a little later on this afternoon. More signs of consumer weakness earlier on today. This time it's Dollar Tree cutting the outlook. Consumer difficulties, the stock getting absolutely hammered. And Anne-Marie, we saw exactly the same thing with Dollar General about a week ago.
Yeah, it's showing that this consumer is struggling to maintain higher inflation, higher interest rates. But what's also interesting is that these stores are the ones that are supposed to do well in this environment. And why aren't they? Look at the mass competition that's come in from places like Walmart that actually says the higher end consumer is trading down. Places like Aldi, they're offering their price cutting, and they are a real competitor now. And that's clearly weighing on these companies.
I mentioned this quote from Dollar General a few times in the last week, mentioned it in the previous hour as well. I think it's worth going over again. Dollar Tree with its own difficulties down 11%, but certainly seeing the same story. Dollar General in the last week, in what I think was maybe the quote of August from corporate America on low-income shoppers, inflation has continued to negatively impact these households, with more than 60% claiming they've had to sacrifice on purchasing basic necessities. When we talk about the inflation story being mission accomplished potentially at the Federal Reserve, for Main Street America, it's anything but. And you can see it in these numbers repeatedly.
This is what Raphael Bostic continues to say. We're getting closer to our target. Potentially we're not there. His concern has always been cutting and then seeing they didn't kill the inflation dragon, then they need to hike again. He doesn't want to do this whipsaw, which is why it's interesting when people come on and say, potentially we'll get 50. How do you get someone like Raphael Bostic to 50 when he still has concerns about some of this inflationary pressures?
Still using the words like gradual and methodical on repeat. Equities right now on the S&P 500, negative then by 0.4. Just to touch base with the bond market, the rally continues. Yields are lower once again on a 10-year down to 381. We're down about 2 basis points on the session. The euro not doing much. Euro dollar 110.49. Crude bouncing by 0.8%, $70.88. Brent crude rallying as well. Just a story that dropped in the last few hours. A conversation now around whether OPEC has to pull back on this increase in supply that was due to happen later this year.
Because they probably want to protect prices, and also they now are going to have potentially a deal in place with the Western and Eastern governments of Libya. Means more Libyan market oil will come to market. So why does OPEC have to add? Also, they are basically fighting the United States. They are fighting more than 13 million barrels a day from the U.S. This is something that they didn't always have to contend with.
Brent crude, 74.14. Coming up this hour, here's your lineup. Laurie Heinel of State Street as the global tech sell-off continues. Lisa is at the Goldman Sachs retail conference. She'll be catching up with the on-holding co-CEOs Martin Hoffmann and Marc Maurer as the footwear brand ramps up international expansion, and Walmart Senior VP Manish Joneja on a new e-commerce lineup. All of that still to come through the next 55 minutes or so. Let's kick it off with our top story. Another month begins with another sell-off. Stocks posting their worst day since the early August meltdown as traders brace for more US data. Laurie Heinel of State Street writing, in the US, economic activity has proven resilient, but we're seeing meaningful signs of a slowdown. More focus is on the labour market now, and we're watching for signs that would indicate more concerning deterioration. Laurie joins us now for more. Laurie, welcome back to the programme. Let's start with your quote. Meaningful signs of a slowdown. Where do you see those signs currently?
Well, certainly we saw some of that in the labor market reports, and the underlying weakness that we're seeing come through there is certainly something that's been concerning. But we've been on the hunt for a while for the Fed to get started with its rate cutting. We actually think that rates at the current levels are too restrictive, given the slowdown in activity that we have seen this year.
Are you leaning back out then of US equities? What are you doing with your exposure to US stocks?
Yeah, so we have definitely paired our exposure to stocks overall, not just in the US, but if you look outside the US, China has been slowing. Eurozone looks really challenged at this point in time. So we do maintain a slight overweight to equities versus where we were earlier this year, but it's much more concentrated in large cap US in particular, with a little bit of fringe exposure in EM where we think valuations look pretty attractive.
Laurie, where is the rest of the world right now? We're having this big conversation around the story at the Federal Reserve. Will interest rates normalize? At the same time, we're trying to work out whether growth differentials can rebalance as well, because growth differentials have been very, very wide, as you know. US great, Europe struggle, China struggles. Do you think we can close the gap in the months to come, or do Europe and China have their own difficulties?
Well, it's very idiosyncratic. I mean, certainly in Europe, they've already started to cut rates, and we think there's room for them to cut further there. The problem there is that you have a lot more pressure from the geopolitical risks that are burdening Europe. You also have a little bit mix in the sectors, which is not flattering. So some of the more pro-cyclical kinds of sectors are more well represented in Europe. So that's an area that we've been quite cautious on, despite the fact that it looks relatively attractive. And then you look at the US, and there are still lots of tailwinds. So we think the consumer is a bit challenged, as we've talked about, but there are places like government spending continues to prop up some of the US markets. And you do still have a lot of the key industries and technology that are dominant here in the U.S.
Lori, when you say the consumer is challenged, do you mean across the board, or are you really just seeing this in the lower end?
Well, it's primarily in the lower end at this point in time. And of course, we've seen things like stock market valuations and housing increases really benefit disproportionately at the upper end. But some of the things that are starting to concern us are broader scale layoffs. We're starting to see announcements of companies that are employing, largely white collar, relatively higher compensated employees. That's an area that we're going to be watching very carefully, because at this point in time, that upper end is not challenged, but that doesn't mean it couldn't become so.
We know that the Fed is now focused on the labor portion of their dual mandate. You say why we believe a 50 basis point cut is warranted by the underlying health of the economy. Explain those reasons. We think the Fed is more likely to cut 25 basis points. What do you think they need to see Friday to move to 50?
Well, I think there's very little that could move them to 50 in September, despite the fact that we think that that's warranted. They've been signaling all along that they're going to be very data dependent. They've been signaling all along that they're going to be measured. They definitely have the inflation boogeyman in their, sights still. So I think it's more likely that what we'll see is a 25 basis point cut, but a bit more forward guidance around how they're seeing this evolve and what might cause them to actually get more aggressive.
When it comes to the data on Friday, when you look at it, do you take it with a grain of salt, given the massive revisions we recently saw?
Well, that's been the big story that we've been talking about all year that I think is starting to finally get a little bit more attention. The fact that at the time when central bankers are focused so much on the coincident data, that data has been very volatile and subject to lots of revisions. And we saw that in the labor reports that came out that actually led to market weakness in August. So it is a sort of a conundrum for them right now, but they have committed to that, and we think they're going to stick with that. But they will look through that. And I think the fact that they're broadening out to look at things like the labor markets instead of, or just not just inflation, is very healthy from that standpoint.
Laurie, it's difficult. We've asked this question a few times already this week, whether we should just ignore headline payrolls on Friday or just subtract 60 to 70,000. I even had a question yesterday, and I'd love your thoughts on this too, whether we should place more weight on the ADP, because maybe the ADP report gives us a better read of things. We had a guest earlier this morning that said ignore jobs, job openings, focus on the beige book later on this afternoon. Laurie, how much weight do you put on one report versus the other this week?
Well, we actually would agree with you completely. You have to look much more broadly, because it's not even just the headline number, but what's underneath the surface. What are we seeing in terms of hours worked, for example? We're also hearing more and more that employees are getting a little bit of pricing power, that they don't have to necessarily pay up to get that incremental employee. So it's not just about the headline number, but look at the detail, see what else is out there, where there might actually be weakness that the Fed will be responsive to.
Laurie, thank you. Big week ahead. Laurie Heinel there of State Street on the latest. Let's get you an update on stories elsewhere with your Bloomberg Brief. Let's cross over to Danny Berger. Hey, Danny.
Hey, John. Volvo Cars is walking back its target to go fully electric by 2030. It's just the latest manufacturer to rein in its EV ambitions on waning demand. Instead, Volvo will aim for 90 to 100% of its sales to be a mix of both fully electric and hybrid cars by the end of the decade. The company said it still plans to become a fully electric car company longer term. Dick's Sporting Goods delivered better than estimated second quarter results and raised its full year forecast for sales and earnings, still falling 1.3% in the pre-market. The report does suggest the sporting goods store is sidestepping widespread consumer caution that hurt other company chains. The company expects comparable store sales, a key retail metric, to rise 2.5% to 3.5% in 2024. That is up from a previous forecast that topped out at a 3% gain. NVIDIA CEO Jensen Huang's wealth tumbled the most ever after routing chip stocks yesterday. Huang's net worth slumped about $10 billion to $94.9 billion on Tuesday, the biggest single-day drop for him since the Bloomberg Billionaire Index began tracking his wealth in 2016. The plunge followed a 9.5% drop in the shares of the chip maker he co-founded. And that's your brief, John.
Danny, thank you. More from Danny again in about 30 minutes. Up next on the programme, the Morning Calls Plus on holding co-CEOs Martin Hoffmann and Marc Maurer as the brand looks to continue gaining market share in the footwear space. We'll cross over to Lisa at the Goldman Sachs Retail Conference in just a moment. From New York this morning, good morning. 1 hour and 16 minutes away from the cash open. Futures pulling back by 0.4%. Yields a little bit lower by a basis point. The 10-year 381.96. Time now for some morning calls. First up, TD Cowen upgrading Sweet Green to a buy with a $43 price target. The analysts seeing strength this year, driving more upside in 2025 than consensus estimates. They've got to do better on portions. Terrible. The protein portions, you notice that? Like it's 4 bits of chicken.
A little bit of a scoop. Yeah, they need to up it up.
Figure it out. Sweet Green up by 2%. That's probably why. Next up, Barclays downgrading Supermicro to equal weight with a $4.38 price target. The analysts taking a more cautious view following poor gross margin in the June quarter and an annual filing delay. The stock is down by another 2.9%. And finally, B of A double upgrading Nasdaq to buy from underperform with a $90 price target. The analysts forecasting a rebound in IPOs following the US presidential election, which will benefit the company's listing business. Nasdaq is up by about 1%. Let's head back to Lisa on the ground at the Goldman Sachs Global Retailing Conference with the consumer very much in focus this morning. Morning, Bramo.
Hey, good morning, John. Honestly, to me, the big question for everybody, I'm sure on Wall Street as well as here, is just what is the state of the U.S. consumer? The state of the U.S. consumer when it comes to running shoes, at least for on holding, is very strong, at least from based on ongoing demand. But there's a real question here about market share. And how do you grow a company this much with some 70% gain in the shares just this year alone at a time where the likes of Nike are seeing a decline of 24%? I'm so pleased to say joining us now are the co-CEOs and godfather of each other's children. We have Martin Hoffmann as well as Marc Maurer. So I want to start with this question of how do you sort of establish yourself in the running category that's highly competitive, where you're also seeing declines elsewhere?
So the mission of the company is to igniting the human spirit through movement. And we started in running. We broke out into many other categories like tennis, like outdoors, training, but also lifestyle. And we want to be the most premium performance sportswear brand. And so we live at that intersection of performance and design. So we speak to a customer that wants to win a marathon. We speak to the everyday runner, but we also speak to the one who loves to move in the product. And I think growing in the premium category is really strong. And to your question on the consumer demand, I mean, we had an amazing summer. We had so many highlights from Paris to the launch with Zendaya. And we had over $1 billion in sales in the first half of the year with 30% growth. So we couldn't be happier with where we are.
So I could just say that, Roger Federer joined with you, you know this, 2018, I believe, owning 3% of the company. You IPO'd in 2021, and it was kind of a slow start. What catalyzed the sort of surge that we've seen so far this year?
So I don't think we had a slow start. We grew consistently by 70% almost over the last couple of years, including the IPO. And I think since the IPO, we've been very focused on executing on our strategy, which was, we wanted to increase the footprint that we had in the US. It was important to start to get into own retail. We wanted to grow apparel. It was important for us to continue to gain share in Asia and in China, and I think we've executed on all of these points. And we knew we need to transition from a phase of hyper growth into a phase of what we call more durable growth. So this is more in the 25 to 30% range. And I think this is exactly the journey we're on. This is what's happening this year. The nice thing is we're at the size now where that still means we're winning a lot of incremental new consumers, and we can give them access to on products, to on apparel, to on footwear. And I think we're quite happy since the IPO on the journey that we're on.
You're a Zurich-based company, but the bulk of the growth has been in the U.S. and in North and South America. How do you see that evolving over time? I mean, is that basically the biggest growth area going forward, or is really China the biggest growth area?
I mean, the US is our most important market, and we make about 65% of sales in the Americas region. At the same time, Asia is the fastest growing market, including China, Japan, Australia. So I think being born in Switzerland, we became a global company very early on. And this helps us because we have so many pillars of growth all around the world that we can execute on. And I think that's a unique position.
I talked about Nike, and they kind of grew up in tandem with Michael Jordan and his star power. You not grew up, but you rode in tandem with Roger Federer. You have the Rogers in terms of shoes. Now you're bringing on Zendaya. She's not a sports star. What sort of does this represent about the shift in how you're trying to target specific influencers in a world that some people are saying the barrier to entry is not lower, but different in terms of potential disruptors based on social media, et cetera?
I mean, Martin said it in the very beginning, we're about igniting the human spirit through movement, right? And so for us, the question was, how can we credibly tap into many different communities and excite them to move? And Roger was absolutely essential to tap into the tennis community, to start to build tennis together, and also make the company known to more and more people, right? Because of obviously the awareness that he has and how he was helping on to reach a larger audience. And with Zendaya, we spotted her wearing the product. And she was wearing the product moving. She wasn't wearing the product just standing around. And so a discussion started, and it was very important for her that more people can get access to movement and that she can shape a little bit the messaging that's happening there and the products that these people are wearing. So that really allowed us to start to work with her on apparel collections, on footwear collections. She's wearing the Cloud Tilt a lot. She has her own apparel line. We're going to see more of that. And so that allows her to bring now that collection to her community. And so On is very much about the end. And this is also what you saw in the air tennis video. Roger couldn't play air tennis by himself, nor could Zendaya do that. And for us to bring both, characters together and individuals together is a huge dream, and we're very, very happy that we can bring that to the world.
How do you sort of see the strategy evolving? One thing that I've been talking with a lot of people this morning is this question around direct-to-consumer, which was, a focus of Nike's, and I hate to keep mentioning them, but, this is sort of the parallel that some people are drawing, and this need to do both, right? This idea to emphasize stores, but also direct-to-consumer, and also website. I mean, how do you sort of navigate that? How does that evolve based on where you are now?
Yeah, we absolutely believe in the power of the multi-channel distribution network. And we started with Run Specialty. They are still a super important partner for us. And because that combination of wholesale partners and our own direct-to-consumer channels, they allow us to reach much more customers in a shorter amount of time. And a few years ago, we started to build our own retail network with the first store here in New York. Now we have 25 stores outside of China, same amount in China. And that channel is performing incredibly well for us as well, and including super high apparel share, so very important on bringing apparel up as an important category for On. So we really see that this combination of the reach of wholesale partners and then being able to connect more closer with the customers through our D2C channels is a very important combination and success factor for On.
You talk about China. There's a lot of concern about what the landscape is going to look like for non-Chinese companies in the mainland, particularly as we don't really know where leadership is going and where the moods are going and where tariffs are going. I mean, how are you navigating that at a time where you're trying to expand?
Yeah, for us, it's about bringing the experience of movement to the consumer, right? And I think this is really what we're focused on. So we have a largely local team. So there's very few actually Swiss or Western people in China scaling the brand. We're focusing on building stores in China, touching the consumers through our digital channels. We're focusing on having the right product available, and it's working out. So we're growing very, very strongly in China. We're very happy. It's together with Japan, our fastest growing market. And I think, you know, the On story and what we've built in the other markets shows that in China we're still very much behind on an adoption curve from a market penetration. And we still feel, hey, there's so much leeway to grow. And how consumer demand is exactly working out in China isn't even that important for us because we're still comparably small. And so I think we're quite positive on how we can look at the near future. And we're also very positive that we can navigate more political topics.
Who do you see as your biggest competitor right now?
I think if you look into our history, we have almost created the market that we are in today. So that premium performance sportswear market. And so I think for us, it's much more of opening up more market opportunities. Take our collaborations with Loewe, for example, where we also open up new price points for our brand. So we focus on ourselves, and really the core is in innovation. So in Paris, we announced Light Spray, which we think has the potential to really revolutionize the running industry, how a product looks, how a product is manufactured, and how you come up to the next level of sustainability. So we are focused on ourselves.
Do you guys go for runs in the morning together?
A lot.
Really?
Yeah, I mean, not so much together actually, because Martin is way faster now. Not so much together, but running and movement is a very important part of our culture. So I think it really helps us to move while we're thinking through problems, and I think it helps us to come up with better solutions. And it's not just us doing it, it's a big part of what the company is doing. And we also did a run this morning with many of the investors at 6 a.m. and so we're helping them to have a good start into the day.
Just real quick here, what's your sense going forward of what that biggest problem would be for this year as you think through it every morning in your runs?
I think the fun part really of our job is to be able to scale and to think about what's the right speed for the company, what do we need to do next to bring the company to the next level. Sometimes it still feels like we are acting in a 500 million company, but we want to be a 3.5 billion company. And that's the fun part. And this is also what we talk a lot with the team about. Embrace the challenge, embrace the uncertainty, and that everything is a little bit chaotic. But I think that makes up the fun.
Marc, Martin, thank you so much for being with us. Really appreciate it. And John, I have to say, as I was eating my bagel, came in this morning and saw them all, gathered together after their run, and it felt very different. Anyway,
Lisa, are you trying to get invited on a run with the team at On?
Maybe. I don't know. It might have been better, but it was a little too late.
Lisa, looking forward to the coverage a little bit later. Lisa at the Goldman Sachs Global Retailing Conference, joining us again in about 20 minutes' time when she'll catch up with an executive from Walmart. Look out for that. Coming up next on this programme, we'll look ahead to the week ahead with payrolls on Friday. Stephanie Roth of Wolfe Research and Amanda Lynam of BlackRock still to come. And later, the Walmart Senior VP, Manish Joneja. From New York City, this is Bloomberg. $60 minutes away from the opening bell. Equities pulling back by 0.4%. In the Nasdaq, we look like this. We're down by 0.7. On a Russell, we're down by 0.5. The pullback continues. It's almost like a repeat of a month ago. The nervousness started with the ISM manufacturing number, kicked in again yesterday. Look, we said this a little bit earlier. I don't think you can point to any one thing for a reason for the sell-off, the magnitude of the move lower that we got across the board yesterday on the S&P 500, on the Nasdaq, on elsewhere. But it continues this morning. If you switch at the board, you see it as well in the bond market. The rally continues in treasuries. Yields lower by almost a basis point at a 2-year. We give just a little bit of that up at 385.70. And in foreign exchange, just a classic risk-off move in yesterday's session. The only thing stronger against the dollar, the yen, and a Swissy. The yen stronger again this morning, 145 on dollar yen. We're negative by 0.2%. Under surveillance this morning, some top stories for you. Nvidia suffering a record $279 billion rout, the biggest loss of value ever for a US stock, thanks to fresh worries over the AI frenzy. This, as the DOJ slaps the chip maker with an antitrust subpoena over its market dominance. So the pain for this name continues.
That's right. And this is actually a Bloomberg scoop yesterday, Jonathan. We know that the company was given a questionnaire, but now it's a subpoena. So basically, that sets up the showdown that the DOJ step closer to a formal complaint on NVIDIA. Their concern is basically they just have too much market share. But we talked to Mandeep Singh. Where else really are customers supposed to go?
Where can they go? What are the alternatives? That is why this name has been doing so well. We'll hear more about those complaints, no doubt, over the next several weeks or so. We'll hear more about this, too, on a campaign trail. This story, the standout one for us this morning. Nippon Steel saying it will appoint a majority American board if its takeover of US Steel is approved. The Japanese steel giant extending an olive branch to US lawmakers who have opposed the deal, including both presidential candidates Donald Trump and Kamala Harris. US Steel saying that if this does not go through, then they might have to shut plants and they might have to move out of Pittsburgh.
If that's the case, then is there going to be a new reaction from, say, Kamala Harris or Donald Trump? The debate is next week. It is going to be in Pennsylvania. And what does every single political analyst come on this show and say? That is going to be the end-all to be-all to this election. The Wall Street Journal editorial board this morning takes no qualms, is going after everyone, the right and the left, and says a politician with the U.S. national interest in mind would celebrate the Nippon Steel deal, which would boost U.S. manufacturing, which is basically what the CEO is saying. And he's saying, if I don't get this cash infusion, I'm going to have to close factories and I'm going to have to lose jobs.
How will they respond to that in the campaign trail in the next week? Especially, and you've said this repeatedly through this morning, Pennsylvania is a big, big state in this election, but it's also hosting the debate between Harris and Trump a week yesterday. Elsewhere, beyond the tech route, traders also keeping an eye on this week's US eco data, including JOLTS, jobless claims, and August payroll. Stephanie Roth of Wolfe Research anticipated 175,000 jobs were added last month, and for unemployment to come in line at 4.2%. Stephanie, I'm pleased to say, is back with us. Stephanie, first of all, welcome back. Second of all, congratulations on your little baby girl. We're looking forward to more conversations with you in the future. So thanks for racing back for Payrolls Friday. We appreciate it. Let's talk about payrolls first, Stephanie. Let's get to it. Payrolls on Friday, the median estimate in our survey around 165,000. We've already heard from the Fed chair, Chairman Powell in Jackson Hole, that he does not welcome any further deterioration in this jobs market. What is further calling further deterioration in this jobs market? How would we define that on Friday?
I think that would be another payrolls print that's sub 150,000. I think that would be the unemployment rate potentially rising up to 4.4%. Again, not our call, but if we continue to just see more signs of softness, our base case is that a lot of the softness that we saw in the month of July was driven by Hurricane Beryl. And we'll see a 37,000 rebound from the state of Texas, in which case our payrolls print will be above 150,000, which we kind of view as trend. So if we see a number closer to 100,000 this month, and we'll have to reassess our sort of view on the labor market. But our base case is the print should come in pretty solid.
Even if we get 150, given the revisions we saw over the previous year, why shouldn't I just chop off 60, 70,000 off that number on Friday?
Well, I think the revisions might be a little bit overstated, right? So we initially had the numbers that came in, and then it was revised down because of unemployment insurance records. And it's actually possible the revisions won't be quite as large once we get the final numbers, because immigration has been playing a role here, and it's possible that's not necessarily getting counted in the unemployment insurance. So basically, it's a lot of noise to say, I wouldn't necessarily chop off 60 to 70,000. Maybe you can chop off 30 to 40,000, but then you're still looking at a labor market that's still growing jobs and an economy that's doing okay. And by the way, consumer spending is growing about 3% in real terms.
Slowing, so not slow. I'd also love to get your take on what happened yesterday with the ISM manufacturing. We just had Andrew Hollenhorst published a report saying a fifth consecutive sub-50 ISM reading shows the manufacturing sector is in a sustained contraction. Do you foresee that through the end of the year?
The ISM has been weak for a long time. It hasn't been a great measure of what's happening in terms of the broad economy. And by the way, measures of sentiment, which is effectively what a PMI is, it's asking, purchasing managers, how are conditions this month versus last month? Same with consumer confidence. That would have told you we were in a recession for all of last year. So I wouldn't necessarily take that as an indication of where actual broad growth is for the economy. That said, the manufacturing sector has been hurt by elevated rates, and we've seen a cyclical slowdown in a lot of parts of rate-sensitive aspects of the economy. We might see that for the next quarter or so, but now that rates have come down, we should start to see a rebound in the manufacturing sector. I wouldn't necessarily anticipate that in Q3. I think Q4 and heading into next year, especially as we get certainty from a political perspective, I think there might be, and they mentioned this in the report yesterday, there might be some hesitation to invest just because we don't know what the political landscape will be, especially from a tax perspective. But our base case is Q4 into Q1, you'll start to see a rebound in the manufacturing sector, and the cyclical parts of the economy will start to pick up.
So basically, are parts of the economy just on hold until after November 5th?
I think that's fair. Well, at least on the cyclical side and the business investment side. There have been some questions about whether the consumers are waiting to see the results of the election. I don't think so. I think the consumer, and we certainly saw that with Q2 GDP, the consumer is continuing to spend in real terms. Certainly goods spending has picked up a little bit. Services spending has been fairly solid, albeit a little slower. But I think it's fair to say on the capital spending side, there are a lot of companies that are just in hold mode. And then once they see the results of the election, realistically, probably either way, they'll be able to start investing again. And they'll have a greater sense in terms of what the investing landscape will be next year.
Stephanie, we've got to leave it there. It's good to have you back. The brilliant Stephanie Roth of Wolfe Research on the latest on the jobs market, looking ahead to Friday and beyond. With us around the table, Amanda Lynam of BlackRock. Amanda, good morning to you. It's good to see you.
Thank you for having me.
Let's get to this credit market. How sensitive has this credit market been to the growth scare of the last 4 weeks?
It's been incredibly sensitive, and I think you can see it both in the widening that happened during the early part of August and the very swift snap back. And I think what that shows you is that the credit market is sensitive to the growth backdrop, especially high yield and leveraged loan issuers in the credit market, not just the cost of capital and the interest rate environment. Starting trading yesterday morning, we had retraced the entirety of the early August widening. We saw almost a record day of new issue supply yesterday in the corporate credit market, so spreads have gapped out a little bit wider than that, but we're still in this kind of narrow range. We're seeing widening get bought by investors. I think the key for credit investors is that, one, yes, the forward path of monetary policy matters, but the reasons behind that rate cut really matter. And then two, we don't need really strong growth in credit to remain resilient. We just need trend or slightly above trend. And I think there's really a wide chasm between a recessionary outcome and the current pace of above trend or slightly above trend growth. And we live in that space in between.
You noted the recent round trip. How symmetrical was the widening versus the tightening beneath the surface? What led and what lagged?
So actually, a kind of higher beta cyclical sectors led the tightening, but it wasn't uniform. For example, triple Cs are still underperforming the overall broader index tightening. But this has been almost a low quality rally in that high yield and leverage loans have been outperforming their investment grade peers over the past few months. That's continued the year to date trend. And so for all of the talk about concerns about downside risks, I think investors are making the calculus that are saying, okay, I'm entering at pretty attractive all-in yields. Growth is slowing, but it's not slow. And therefore, the outcome for corporate credit investors can be quite resilient in that backdrop.
What are you personally advocating for?
Yeah, so I think there have been a couple asset allocation shifts that have been super relevant. The first and foremost has been the trade-off between high yield and leverage loans. For most of this year, that equation was very clearly in favor of leverage loans because of the rate backdrop. I think it's now shifted more neutral between high yield and leverage loans. That's one. Two, the recent volatility has showed us how quickly the market can change. That's especially true for the borrowers that may have found that they were locked out of the market even just for a short period of time. So I think we've seen more interest from investors on kind of private capital, something that's not at the whim of the public market volatility. And then three, I still like moving down in quality within the investment grade spectrum. I think one of the key developments since the pandemic is that cliff between downgraded from IG to high yield isn't as severe as maybe we would have thought several months ago. And so if you can own BBB rated firms that have a strong incentive to stay investment grade, and even if they do fall to high yield, will likely be supported and bought, I actually like that. So I think within IG, moving down in quality makes a lot of sense. Within high yield, I would not go all the way down in quality to that triple C cohort because they've lagged.
When you say the corporate credit reaction to the cuts is more important, aka normalization or easing, because they're actually seeing
the deterioration in the economy. That scenario is not reflected right now in valuations. What would it take for that scenario to be reflected?
You're exactly right. I think 316 is where we are on the high yield index. That's nowhere near even the post-financial crisis average. So what we are baking in at the moment is truly a pretty benign outcome for credit. I think, as Stephanie mentioned, you would need to see deterioration in the labor market, the growth backdrop that is consistent with the weakness that we saw in July, such that it kind of spooks credit investors that growth is not even at trend, but actually meaningfully below. That's really the critical factor. But again, so long as we have trend growth, companies have shown that they've had an ability to navigate this cost of capital environment. And so really, it's an extreme downside risk to growth. Now, I think the important thing for investors, though, is there is a lot of room for spreads to widen. In such a scenario where we're kind of nearing kind of not recessionary levels, but a sharp slowdown, I think you could see spreads go to 550, 600 from 316. So there's a lot of room to widen.
You've got your finger in the pulse of this market. I think an interesting question for Friday would be how sensitive this market would be to stronger than expected data versus weaker than expected data. What would generate the larger move?
I think weaker than expected data because it feels to me like stronger than expected data is almost priced in at the moment. I realize that GDP can be revised and third quarter's tracking at 2%. So I would say that's not extremely above trend. But we've had resilient growth all year. And I think the consumer has surprised to the upside in terms of spending, albeit bifurcated.
Just quickly, on supply, you mentioned it. The amount of supply we've had in the last 24 hours, the announcement of companies bringing debt to market. Are they operating from a position of strength or weakness or stress?
A position of proactivity and strength. And Stephanie had mentioned kind of capital spending slowing, but capital management has not slowed. And so companies, I think, are being proactive in terms of capital management and the balance sheet as they move towards later in the year in the event risk.
A clinic, as always. It's good to see you. Thank you. Amanda Lynam of BlackRock with the latest in the credit market ahead of that jobs number on Friday and the Federal Reserve decision on September 18th. That meeting starts on September 17th. Let's get you an update on stories elsewhere with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. The Nordstrom family has offered to buy the Nordstrom department chain. In a statement filed moments ago, the family would offer $23 per share. That is a 0.8% premium to Tuesday's close. The U.S. department store chains, multiple of them, have been suffering as consumers increasingly buy direct or online. Deal making has been seen as one of the potential solutions to the industry's woes. Nordstrom earnings last month were better than expected, though, thanks to its discount rack chain. U.S. mortgage rates fell to their lowest level since April 2023. According to data released by the Mortgage Bankers Association last week, the contract rate on a 30-year fixed mortgage dropped to 6.43%. That's the fifth consecutive weekly decline. The drop spurred a pickup in MBA's index of home purchase applications, which rose 3.3%. In the U.S. Open semifinals, it'll be an all-American face-off in the men's tournament after Taylor Fritz upset Alexander Zverev. Fritz is headed to his first ever semifinal where he'll take on Francis Tiafoe, which last reached the round in 2022. In the women's tournament, Audrina Sabalenka defeated the Olympic gold medalist in singles and will be taking on American Emma Navarro for a spot in the final. And that's your brief, John.
Very, very cool. I need to check the prices of Tiafoe Fritz. I imagine no one can afford it. It's just ridiculous.
You also need to check whether or not you can get a car into the U.S. Open to take you home.
That is a very, very different thing that we can talk about another time. It's personal. Up next on the programme, setting you up for the day ahead. Plus, we'll head back to the Goldman Sachs Global Retailing Conference with Lisa standing by with Walmart's Senior VP, Manish Joneja. That's up next. This is Bloomberg. 44 minutes away from the cash open. Equities pulling back by a third of 1% on the S&P 500. Giving up some of the rally in the bond market, the 10-year now just about unchanged. Your yield 383.10. Let's head back to Lisa now at the Goldman Sachs Global Retailing Conference. Hey, Bramo.
Hey, how's it going, John? Honestly, this is one of the conversations that I've been looking forward to for quite a while, since we talk all the time about how essentially the big are getting bigger and Walmart and Amazon are very much dominating the landscape in terms of sales and accumulating market share. And a big part of that has been the e-commerce site, as well as some of the new businesses that Walmart has been charting into. Key among them is the U.S. marketplace, as well as, of course, fulfillment, just the idea of getting packages out. And the person who heads both of those is with us right now. Manish Joneja, who is here in New York City from the West Coast, actually from Bensonville. I'm curious just to start with this idea. We've seen e-commerce, fulfillment, Walmart really transform itself in terms of who it caters to and how it caters to them. How big could the whole e-commerce really get?
So first of all, thank you for having me. I would say we're barely starting. When you think about e-commerce, it's all about working backwards from our customers, which we've been doing for 6 decades. Now, as we started ramping marketplace up, that's just been the past 3 years, when we open to more sellers from more markets to be able to bring the additional assortment for our customers. What we see is customers want options and choices, they want convenience, and they want low price. So when you think about expanding more categories, you think about expanding more services to sellers. For example, last week we just announced premium beauty to marketplaces. That's a new addition, and premium beauty is one of the top performing categories in beauty. We announced collectibles last week. We announced expansion of pre-owned. So if you have kids like me, you would want to have an option of a high quality, lower cost iPad that they can break, which they did for my kids, so I can save money to spend somewhere else. So what we do is help people save money and live better. And the more choices we bring to the platform, the more we see our customer cohorts increasing, buying more often, buying more items.
Well, I have to say, when I think of Walmart, I don't think of Kendrick Lamar like Jordans, and I don't think of some of the StockX offerings that are coming out there. And we often talk about how the consumer is trading down when it comes to Walmart, and they actually are looking for deals. That's not really accurate. It's much more that Walmart is catering to different customers, correct?
Yeah, I think you put it aptly. It's about us serving a wider customer base. When you think about, again, marketplace, right, the broad assortment that we bring, we see that our customers are looking for a variety of items. It could be a rare collectible item they're searching for. It could be pre-owned example I talk about. It could be premium beauty. It could be a refurbished Dyson, for example, right? So we all sell all of those different items. And to give an example, the Kendrick Lamar shoes, right? So we see a lot of people going after coveted current culture items. StockX, if you know about them, they sell sneakers, they sell collectibles, and we, Walmart Marketplace, is the first destination they've come to list their assortment. So we're starting them next week with hundreds of SKUs, and we plan to expand that to tens of thousands. So now, as a customer of Walmart, and guess what? You can buy a grocery, you can buy a fresh food, you can buy any assortment you want. You want to buy luxury fashion items from us and trust, the same trust and convenience that we bring to the table.
There's this sense that you get a sort of a lower cost fulfillment, a lower cost distribution for participating with Walmart. What's sort of the vision for that distribution? Is it mostly just going to a store and picking it up? Is it that there will be a Walmart fleet similar to what we see with Amazon and FedEx?
Just much more than that. So I've been a seller as well on the platforms, and I've worked in different marketplaces. Fulfillment is one of the most challenging aspects for any business, be it a small business or be it a large brand. So whether you're an entrepreneur or large company CEO, fulfillment is complex. We have become incredibly good at it. We've been doing this for the past 60 years with an incredible supply chain operations team. So Walmart Fulfillment Services, or WFS, is our low-cost end-to-end network that powers our sellers with the same world-class supply chain that we built. It offers prices that are typically 15% lower than market. It basically is end-to-end, so we have our sellers back. Our sellers have actually asked us to extend that service to their own business. So think about them serving non-Walmart sites and customers. We announced last week that this month they can actually do that. Another aspect of it is our sellers have asked us, can you help us pick up the items from end to end, pick it up from Asia, put it in the right fulfillment centers, fulfill it. We announced that as well. So we are doing an end-to-end one-stop shop for our sellers to be able to use.
One thing that Amazon's been accused of is prioritizing their own brands and sort of downplaying some of their customers. It's one sort of reason why you've heard a lot of pushback, and Lina Khan sort of pushing back on that. How does Walmart distinguish itself on that front, sort of avoid getting ahead, or try to get ahead of that?
So let me talk about Walmart, right? So Walmart is in a category of its own. We are more than a marketplace. That's what we're building. So building all the connectors of a marketplace, fulfillment, ads, omni-channel. There's no other retailer with the broad reach that we have to our customers, with the digital and physical integration that we have. And when you think about it, 90% of America is within 10 miles of a Walmart store, right? Omni-channel is a really strong advantage that nobody else offers. So when you think about omni-channel, let me bring it to life. On our marketplace,
sellers can sell tires that they can ship to more than 2,300 of our super centers that have auto care centers. So you can ship the tire, we'll install it for you. Like that basically erodes the boundary between 1P and 3P for a customer and just has the excellent experience you can deliver. Second, you can walk into more than 4,000 Walmart stores and just return your item. That's again a very key advantage. Third, what we see is we had Seller Summit last week and we had merchants who were talking to our sellers and the line was out the door. We've seen really strong brands come in through Marketplace, list their entire assortment, and then if they're performing really well, we put them in stores. Arctic Cooler is a pretty good example of that. And last but not the least is we really believe in working together. So we are building the platform for sellers to serve our customers with sellers.
How big do you see the marketplace getting? How big do you see, just in general, e-commerce as a proportion of the overall business?
I think Walmart e-commerce and marketplace is the biggest opportunity in retail. And the reason is we're just starting, right? We're a few years old. We only opened to new sellers a few years ago. And think about, again, large premium assortment categories and experiences. We're getting more and more brands on board. So it's all from customer demand, right? Every morning when we wake up, we think about what a customer's looking for. We want to make sure those items with the right price, with the right quality, with the right speed is on the platform. Premium beauty is attracting more brands. Collectibles, I mean, this is going to keep on going. We're just starting.
There's a sense also going forward about how you plan to arrange with certain geopolitical concerns with respect to regions. Are there certain regions that you see this expanding in more than others?
So we are in about 19 countries, but think about marketplace, right? So we are US, Canada, Mexico, and Chile. And last summit we announced was sellers wanted to be made easy for them to reach our customer base. So as we expand these marketplaces, these sellers are not able to sell into all those countries with a single click. What we educate our sellers on is this is the in-demand assortment, or this is what customers want. How to get them is what they work on business, and we expose their assortment search. So search, for example, we're talking about this, right? It works on behalf of the customer. When you walk into a Walmart store, there's a store associate or a manager who would help you find the item that you need. They'll guide you to the TV, they'll guide you to the Samsung TV that you want. Think about search as an online store manager. So it's irrelevant to us whether we own the inventory or a seller does, and we work on their behalf to give you those items.
How are you deploying AI in this? Because that's sort of the hot topic, and you've got a lot of data that you've accumulated through the website.
Yeah. So AI is spread across our ecosystem. And think about, again, from a seller-based standpoint, what we do is, if you're listing an item, we make it easy for you. We'll help you figure out the right images, the right content, the right category structures that you can list on. We'll help you with intel on what the price could be in the market. Same thing that's implemented across the supply chain as well. So it's across. There's no one vertical. It's embedded in the DNA of the company as we expand.
In 10 years, do you think Walmart is going to be a platform? Do you think it's going to be an advertising and media company? Do you think it's going to be a big box store? Or do you think it's going to be all of the above?
I think it's going to be, and it is, the first place to shop for our customers, and it'll be the first place for our sellers to stop. Because if we have those right items, our customers come more frequently, they buy those items more frequently, and they can find different ways of delivering it. So it's the first place to shop.
Manish, Joneja, please don't be a stranger. Thank you so much for being with us. I look forward to talking with you more as this does evolve. It is 3 years old. John, this to me is fascinating. We've talked about this extensively, just how Walmart and other companies, but Walmart in particular, has really been expanding into a very new market. And this really gives you a sense from my sneakerhead son just how much
of course
they are.
We knew this was personal. Lisa, thank you. Brilliant coverage this morning, and looking forward to having you back in the hot seat a little bit later tomorrow morning. Lisa at the Goldman Sachs Global Retailing Conference. Look out for more conversations from that throughout the day on Bloomberg TV and on Bloomberg Radio. Coming up tomorrow, looking forward to having Lisa back because we've got quite a 24 hours coming up. Your trading diary, the calendar, looks like this. JOLTS data coming at 10 a.m. Eastern Time, along with durable goods, plus the Fed's Beige Book coming at 2 p.m. Eastern. Tomorrow, we'll get the ADP employment report, plus another round of jobless claims and ISM services. And on Friday, it's the main event. It's Payrolls Friday. It's a pretty soft start to the month of September. The losses continue. We're down 0.25% on the S&P 500, pulling back just a touch. Going into tomorrow to respond to all of this, John Stolfus of Oppenheimer, former HUD Secretary, Sean Donovan, Ed Al-Husseini of Columbia Threadneedle, and Kathy Jones of Charles Schwab. From New York, this is Bloomberg.